Good morning, I'm Brian Sozzi. This is Yahoo Finance. Let's kick off this Monday with three things you need to know to start your week. Coming in at number one, inflation data is the talk of the town this week with January's consumer price index out tomorrow. We'll be keeping an eye on the big annual headline number, which is expected to fall on the month, but don't sleep on core inflation. That's likely to show a 0.4% rise on the month. Why should investors care? Because it takes volatile food and energy out of the equation and looks beneath the hood. Second thing you need to know, is it a bird, a plane, or an alien? The U.S. is on high alert after another high-flying object was shot down by an F-22 over Lake Huron this weekend. A U.S. official causing some heads to turn by not ruling out extraterrestrial activity. If you're losing count, this marks the fourth time in just over a week that U.S. forces have brought down objects over soaring North America. First such instance was, of course, that balloon. These tensions not good for China stocks in today's early trade. And the third thing you need to know, the Super Bowl. Well, the football took a backseat to a show-stopping halftime performance from Rihanna, and that's all anyone can talk about today. The game itself, the Chiefs upset the Eagles with Kansas City winning their second ring in the past 4 seasons. As ever, the commercials were also a talking point, from Ben Affleck at a Dunkin' drive-thru to John Travolta singing yet again. Companies pulled out all the stops, spending a whopping $7 million on a 30-second spot. All right, so our top story. It's a big week for stocks, of course, as Wall Street tries to rebound from a rocky week. And we're getting a mixed message from major players on Wall Street. Goldman Sachs has upgraded its view on stocks, while JP Morgan, they are saying the opposite. And Julie, also a big week for economic data. But hold me, let's start on these notes here. JP Morgan really sounding the alarm bell, essentially saying to investors, you know what, all these gains we've seen in the first quarter, well, that's as good as it's going to get. We are concerned about valuations. We're concerned about sticky inflation. And we are, of course, concerned about what big companies are telling people about the economic slowdown.
Yeah, definitely. That's what we're going to talk much more about that in the morning brief in just a little bit. But it seems like after that down week that we had last week, the first of the year, it seems like now a lot of strategists are sort of taking a step back and saying, okay, not so fast here. Let's not get carried away. Mike Wilson, one of those folks indeed who is out with that, who said the equity market is refusing to accept the reality that the Fed might remain restrictive for longer than anticipated. And that seems to be sort of a growing chorus that we are hearing from strategists.
Yeah, just diving into this JP Morgan note, they're actually recommending investors reduce beta. Now, it's just a lot of fancy talk, really essentially means cut your exposure to stocks, and most notably tech stocks. Of course, tech stocks have really rallied out of here, out of the gate. You've seen falling bond yields on this view, and maybe the Fed is not out there continually to aggressively raise interest rates throughout the year, so tech stocks have benefited from that. But JP Morgan also noting a consumer spending slowdown, which was pretty interesting as well, saying consumers may have exhausted all their savings and they just have nothing else, no other money to out and spend this spring.
And something else, speaking of where investors are putting their money, according to some data pulled by the Journal from Refinitiv Lipper, investors have pulled $31 billion from U.S. equity, mutual funds, and ETFs in the past 6 weeks. So even though we have been seeing stocks go up in aggregate, we have been seeing U.S. equity funds see outflows. Where are they putting their money? They're putting it into fixed income, which is no surprise, given what we've been hearing from investors, and also international equity funds. So that's what's been attracting the money thus far this year. So it's interesting here that mostly we're talking about equity investors here, or money managed on behalf of equity investors, if you're talking mutual funds and ETFs. So it's interesting that they are a little more cautious.
And of course, look, I mean, I think it was JP Morgan, or another note I saw this morning, maybe Berenberg. The market, the S&P 500 is up 14% off those October lows. That is a huge move considering where corporate America is. And then I can't say I'm surprised by these notes, just given what we've seen in AI stocks, a lot of these fear of missing out, FOMO rallies starting to permeate the broader market. Of course, you're going to have these folks, a lot of these Wall Streeters come out here and try to be heroes and say, you know what, the top is in for the year. You know what, maybe we don't see these gains continue into the back half.
Yes, we'll see, though. And in terms of what we're watching this week, it's a big week for economic data. There is one release that everyone is keeping an eye on. That's January's Consumer Price Index. Economists are expecting inflation to rise 0.5% for the month. That's a notable increase from figures seen in recent months. We've seen a deceleration. That would be an acceleration. For more, or a real acceleration. For more, let's bring in Cumberland Chief U.S. economist David Burson. David, thanks for being here. So what do you think? What do you think we're going to see from CPI? Will it, in fact, show that those who are talking about disinflation, maybe not so fast?
Well, certainly for January, we're going to see a reacceleration in inflation. I think the 0.5% estimate that is the consensus is probably going to be pretty close. Now, that doesn't mean that we're not seeing a disinflationary trend. The decline last month, we're not seeing negative inflation. We're not seeing deflation. So a bump up this month probably shows too much inflation. Last month certainly showed too little inflation compared to what's actually happening in the economy.
Well, David, what is actually happening in the economy as it pertains to inflation?
Well, inflation is slowing, not slowing nearly as much as it showed last month. If you look at the 12-month change, we still have some pretty hefty inflation. It's down substantially from the peak, and we'll probably see inflation continue to moderate as the year goes on. But even by year end, optimistically, inflation is still probably going to be up 3, maybe 3.5% from a year ago. Now, that's still well above the Fed's 2% target, but well below where it was at the end of last year.
So what does that imply about what the Fed's going to do about it, right? And all of this continuing market disconnect that we've been talking about between the Fed telling us that they're going to keep going till they get inflation under control, and the market would seem to think that they're not.
I think the market is hoping that inflation comes down more quickly, or we go into a recession more quickly, and that will force the Fed's hand and force them to ease. If inflation is somewhat sticky, if it's still over 3% by year end, even if we go into a mild recession, the data's always lag. My guess is that the Fed will not ease this year. It may not tighten much more. We might see Fed funds at the peak going a little above 5, but that's very different from an expectation that by year end the Fed will ease. I think it's very unlikely, unless inflation just plummets or we go into a meaningful recession earlier in the year. It's very unlikely the Fed will ease this year. So I think we'll see Fed funds, even at year end, over 5%.
So, David, even if we do get a mild contraction in growth, which a lot of economists certainly are looking for, you don't think the Fed will try to just improve that by cutting rates?
No, I don't think that the Fed will, unless it's a more meaningful downturn where inflation where unemployment is soaring. The Fed does not want to make the same mistakes it made in the 1970s when downturns in the economy caused the Fed to ease monetary policy before inflation was taken out of the system. And that simply caused inflation to bump up even higher when we got the next expansion. The Fed does not want that to happen. Ultimately, that's a much worse course for the economy. The Fed is probably correct to stay the course, getting inflation down, unless there's a really big recession.
David, I'm getting a lot of mixed reads on the health of the U.S. consumer. On one hand, you've seen them work down their savings to very low levels. I think you are seeing that work down appear in a lot of restaurant results, but they don't appear, I'm seeing some of that work down also going towards vacations, but they don't appear to be out in the malls buying willy-nilly or aggressively. What is the true state of the U.S. consumer here?
The consumer can't be in bad shape if we're seeing strong payroll numbers and strong wage numbers. And we're seeing both of those. Now, yes, it's true that consumers have spent down much of the excess savings they generated during the COVID downturn, much of the government money that was given to them. But still, with last month's payroll number over 500,000 and wages going up pretty rapidly, consumers have a lot of wherewithal to spend, and they are spending it. Now, they may be changing from savings to current income and perhaps to credit cards as well. But this week we get retail sales for January. That's likely to be up quite a bit as well, almost 2%. We're looking for an increase of 1.7 to 1.8%. We already know the light vehicle sales were up strongly for the month. If you look at data from the major credit card issuers, they're saying that consumers over the month continued to spend. So, the consumer's not dead yet.
Good to hear. David Burson, thanks so much. Cumberland Chief U.S. Economist. Thanks for your time this morning.
Glad to be here.
The U.S. military shot down an octagonal object over Lake Huron early Sunday. This is the latest incident involving a floating or flying object since a suspected Chinese surveillance balloon was taken down last week, putting North American security on high alert. Joining us now with more on the story is Yahoo Finance's Rick Newman. Rick, this story obviously is getting a lot of attention because, there's A, the concern about security, but B, because it's just so weird, right? Like, why doesn't the U.S. government just say what this stuff is?
Well, I think it's worth taking them at their word for the time being that they're not really sure. I think people have this assumption that the Pentagon can see everything everywhere And that is not the case. My understanding of what's going on here is this stuff has basically been sneaking into U.S. airspace because the radars that monitor U.S. airspace are not designed to pick these things up. They are designed to pick up the things we all know about, which are jet aircraft and missiles. And I think what happens is when you adjust for something like balloons, which are not easy to see on radar, what I think happens is you start getting all kinds of false positives on the radar. So you start picking up a lot of smaller stuff. But I think what clearly has happened is they have tweaked the algorithm on the radars, so they're now finding more stuff. And they're probably having to sort through a lot of additional signals as well, which can be problematic. So this is going to get worked out. But in the meanwhile, a couple of things. How many more of these objects are there? And what in the heck is going on in China? If you think that most of this or all of this is coming from China, what is Xi Jinping thinking? I mean, this is not good. This looks like China does not have its act together. Are these things going to continue to drift into U.S. and Canadian airspace because they're already floating around up there and they can't be recalled? Or are these deliberate provocations? But this is not good for China, and obviously it's a major chill on U.S.-Chinese relations.
Well, Rick, it can't be good for President Biden either. Now you're seeing Republicans use this as an opportunity to attack his leadership. Is it something that will have staying power and hurt any potential re-election, things he would like to achieve?
Well, notice what's happened there was a difference between the first big balloon that drifted all the way across the United States before they shot it down and these other ones. So Biden's now pow, pow, pow. He's shooting them down all over the place, right? So is that a response to Republicans who said he wasn't aggressive enough by not shooting down the first one right off the bat? I don't know. Honestly, I would love to see them try to capture a couple of these things if they can. They may have some technology where you can sort of get these things into a net. They have been able to do that with satellites in the past. It's an interesting question. To what extent do the intelligence people say we would love to have one of these things intact to be able to figure out what it is without having to deal with, wreckage and debris? And the political side and the White House is saying we can't afford that politically. We just have to look tough on these things. This is going to play out over weeks and months. Even if there are no more of these things, I think we're probably going to get some assessments from the intelligence people. Some of that will be classified, but they really need to say something publicly about what's going on here. There probably will be more briefings for Congress, perhaps some hearings. So we're going to learn a lot more about this.
They just need to strap a jetpack on somebody and send them up there, an airman, and send them up there to take some photos and video of the thing. Come on, it seems pretty straightforward there,
Rick.
Well,
let's be real. They are doing that. I mean, they are flying U-2, the old U-2, which can go.
Right. I mean, they must have pictures of these things before they shoot them down.
Absolutely. So that's what everybody is not thinking about this. They are looking as closely as they can at these things. The old U-2 from the Cold War days, that can fly, I think, as high as 80,000 feet. It can stay up there for a long time. It can take pictures. They have all kinds of other sensors on that airplane, audio sensors, technical sensors, measurement sensors to figure out what these things are doing. So it's really not the smartest thing to just shoot these out of the sky. The moment you know they're there, it'd be better to learn as much as you can about what they're doing. So to some extent, all these people, these trigger-happy Republicans saying, just shoot at everything, that is not the smartest move, I think, from an intelligence gathering perspective.
Well, keep looking up today, Rick, and please do flag our breaking news channel if you see anything new. Rick Newman, thanks so much. Appreciate it. Kansas City fans are rejoicing this Monday morning after the Chiefs defeated the Philadelphia Eagles 38-35 in Super Bowl 57 after NFL MVP Patrick Mahomes rallied his team to a comeback in the second half. Aside from a controversial holding call late in the fourth quarter, viewers have a lot to say about another aspect of the big game, the commercials. From Ben Affleck to Bradley Cooper, we'll break down which companies scored big and which fumbled the ball later on in the show.
Today's morning brief up on the Yahoo Finance homepage discusses how executives are doing a great job of talking down the United States economy. Yet amid the cautious C-suite talk and relatively weak earnings growth, the S&P 500 is up so far in 2023. And Saz is the one who wrote the brief. Luckily, he's sitting right here next to me, so let's talk about it, Saz. It is interesting, the sort of disconnect, right, that we are seeing between the rhetoric and I mean, it's not necessarily unusual, but it is interesting.
Well, I was reading this and I'm like, wow, I really like that. And I'm like, I wrote it. Of course, I really dig it. I will say this. I love the Morning Brief newsletter every morning. Our team does it.
No matter who writes it.
No matter who writes it. Especially you, Julie. I love what you when you write it. But look, we've seen a lot of executives here, and the point of this newsletter today is, I think, really trying to get investors to understand what we're hearing from a lot of executives. We talked to XPO CEO last week, voicing, I would say, concern about how things are shaping up for their key month of March in terms of delivery and retailers. We've had Starbucks come out here and warn. We've had other companies come out here and not say good things in terms of not only how the fourth quarter panned out, but really how things started for the first quarter. And then you take that negative commentary, you compare it to an S&P 500 trading at about 18.5 times forward earnings, and that's just, something's mismatched here. And at one point, does this market break and start to, price in some of these concerns here by corporate America?
Well, it is pricing it in when it comes to specific stocks, certainly, right? The companies that are coming out with this negative stuff,
they've been hammered. They're
getting punished, right? So it's not like that investors are overlooking it on a specific stock basis. It's more just overall, we are not seeing that kind of reaction in the market.
Yeah, I think we talked to PepsiCo CFO Hugh Johnson last week too, and I've talked to Hugh probably 7 or 8 years. I've never even heard him say the word recession. And to hear him come on Yahoo Finance and say, my base case is a mild recession this year, that definitely raised red flags. Red flags. They're seeing strong results, but still he is looking beyond the first quarter, maybe a seasoned CFO, and telling us growth may slow sharply.
Okay, so a couple things. Yes, Pepsi is still seeing strong results, but he also made it clear, and I think this is something that companies do, they plan for the worst.
Sure.
That's part of their job. So I think that you have to sort of take some of the negative commentary with a grain of salt from these corporations. Better for them to guide negatively or pessimistically and beat than the opposite, right? Better for them to plan for the worst and then have things turn out better than the opposite. So I think maybe that's also why investors are sort of focusing on their own scenarios and not necessarily the rhetoric that we're getting perhaps from some of these CEOs.
Yeah, no, well, let's continue to dive into this. Has the stock market gotten too gymmed up on hopium, like we've been talking about here all morning long? Young-Yu Ma is Chief Investment Strategist at BMO Wealth Management. Young-Yu, good to see you as always. Your take on the morning brief. You think the market has just gone too far too fast here?
Well, I do think it's a natural reaction that we're seeing for CEOs to be somewhat cautious here. The market's been very forgiving, but we've had this uncommon or unprecedented boom and bust really at the same time, depending on which sector you're in and where your business is. So I think that the market needs a period of digestion here, especially since we have a bit of a shift in terms of what the expectations are for interest rates and still a very strong labor market and wage gains that have been coming down, but still are a little bit on the high side. So I think all this makes sense, but it's probably an air of cautiousness that CEOs are having right now.
So Young-Yu, what does that period of digestion look like for the markets? Is it sort of a sideways movement? Is it more volatility? What are you expecting for the next sort of midterm period?
Yeah, I would expect more sideways movement. I think we still have to wait to see how the data comes in. Really, the market for so long, or to start the year, had been keying off the idea that interest rates are actually going to come down toward the end of the year. And now that that expectation is removed from the market, I think we just have to see what the data holds for us. Is inflation going to come down the way people expect it to? Is wage growth going to come down? Are there going to be other signs that are concerning the economy? Is the labor market going to be too hot? I think it's really a period of wait and see and digest these gains to see if the same thesis that the market had been really pinning its hopes on to begin the year still plays out in the middle and end of the year.
And where do you stand today on the move in tech stocks? We've seen tech stocks, by and large, not all of them, but a good number of them rise as we've seen the 10-year yield pull back. But some of these tech results have been awful, and now you just continue to get news of layoffs across the board.
Yeah, I think we're neutral on tech stocks overall. I think the news of layoffs in some instances, of course, has been taken positively because a lot of these tech companies really gorged on hiring during the pandemic. So a lot of this we see is rationalization, probably sensible cost cutting, and we see an environment going forward, of course, of one where we're going to see a lot of dispersion among winners and losers. But there has been a big run. Interest rates are probably going to rise a bit on the long end of the curve, and that's going to provide a headwind for tech stocks. So it's not our favored sector here, but it's one we still think, of course, in the medium term and long term has a lot of growth potential.
And we're looking ahead as we talk about all this inflation talk. We talked about it a moment ago, that tomorrow's CPI release is going to be important for the markets. But you point out, as we go forward, maybe there's other stuff that the investors need to be looking at as well. What's in your sort of data suite right now that you're prioritizing?
Yeah, as long as a CPI report doesn't surprise too much either way, it might not be as market moving as it's been in the past few months. I think a lot of what's going to be focused on going forward is wage growth. The Fed is very concerned about the labor market being too tight. And the Fed's concern is really about not just inflation coming down in the near term for the next couple of months, but what's going to happen toward the end of the year and next year. And the Fed wants to see that wage growth is in a comfortable place so that we don't see the type of reacceleration of inflation that might happen or that's happened in the past. So I think there's much more to the data that the Fed's going to be looking at here.
Have you started to bet against the U.S. consumer?
No, I wouldn't bet against U.S. consumer. I actually think we're going to see inflation come down by mid-year and wage growth still stabilize and stay in a healthy level, and that we'll see wage or income gains in real terms adjusted for inflation. And that's going to help to stabilize spending here. I think the consumer overall is going to hold up well, even though there are some clear strains at sort of the lower income spectrum right now.
Young, good to catch up with you. Thank you so much. Chief Investment Strategist at BMO Wealth Management. Appreciate it.
Coming up, Zillow Group is getting a boost on the back of an upgrade from Evercore ISI. We'll discuss that, plus have the opening bell on Wall Street next. Novavax announces a modification to its existing agreement with the U.S. government to deliver up to 1.5 million doses of its COVID-19 vaccine. This agreement is part of an ongoing efforts to smooth the transition in bringing the vaccine to the commercial market. And Novavax, Julie, was just very late even getting into the COVID-19 vaccine game. That's why you've just seen the stock continue to be hammered. But today, a little bit of well-deserved news, I would say, for Novavax.
Yeah, I mean, Novavax has a protein-based vaccine versus the mRNA vaccine that has been so much more prevalent, right, by the other vaccine makers. And so Novavax has been sort of an also-ran in this whole situation. As we know, the government is winding down the emergency status of the COVID-19 pandemic. And we know that the government already holds a number of Novavax vaccine. In fact, they bought 3.2 million doses of the vaccine. But a lot of those have either expired or they're going to expire. Some people can't take the mRNA vaccines because of allergies. So Novavax vaccine would represent an alternative for them. So that's one of the reasons that this is an attractive thing for the government to do. So it's definitely helpful. There's also the journal reporting that the government is also going to support the company's efforts to develop other vaccines, protein-based vaccines for other illnesses. So we'll see what ends up happening with those efforts as well.
Just a little kick in the pants because, of course, you have a new CEO at Novavax. Kick in the pants to Stanley Erck. He just stepped down January 23rd as CEO. New CEO, John Jacobs. So win for John, a kick in the butt for Big Stanley.
Yeah, and those Novavax shares, by the way, fell some 93% last year because the vaccine did not prove to be sort of as popular or as profitable as perhaps expected. And then they haven't bounced back this year, by the way. They're still down by about 4%. So that's something to mention as well. Something else that we are watching this morning, shares of Twilio. And I'm just looking at the blog posting here in which the company says it is cutting more jobs, 17% of the team. They're forming two business units, Twilio Communications and Twilio Data and Applications. All of this in a blog post from Twilio CEO Jeff Lawson.
Julian, I knew this sounded familiar. In late September, Twilio announced an 11% reduction, and you had Jeff Lawson putting out a blog post back then to all his what he calls Twillions. Back then, he was saying he didn't want to sugarcoat things, but at what point does this fall on Jeff Lawson? I mean, you've laid off, close to 30% of your workforce in 3 or 4 months, and now you're announcing a major strategy shift. I mean, this is terrible leadership.
Yeah, I mean, as we talk about some of these stocks and what they have done, Twilio shares are bouncing some 7% this weekend because, as we know, the market has liked news of cuts. Twilio shares were down 81% last year, so that also falls in the on the more dramatic side of the spectrum in terms of, we know a lot of tech companies had losses last year, but that outpaces a lot of them. The shares have bounced back about 23% this year, so they've followed the trajectory that we have seen for a lot of this sector.
And of course, this initial move you're seeing in Twilio is on the expectation that maybe in the first half of this year, they've laid off about 28% of their workforce, expenses will be down, maybe they'll blow away earnings estimates, but just keep this in mind. When you cut this deep to your workforce, it just does stuff to your company's DNA. Maybe you just can't grow your top line as fast as you would have liked. It just alters the way you do business and, of course, hurts morale.
The company also talks about, speaking of morale, that they're winding down some of the perks they've offered in the past. They said, including our book and wellness and allowances. I guess people got a book allowance, which is kind of cool, but they're not getting that anymore.
Book allowance.
A book allowance.
A book allowance. I will take $10 out of my paycheck and go download a book from Barnes & Noble to my e-reader. Come on, cut that out, cut it out. Get more focused, get more focused.
Do you know how many books are available from your public library as ebooks?
Or go to the public library.
As ebooks?
How many?
I'm a big fan of the public library.
Me too. I love the public library. I still go there. I went 2 weeks ago.
Like almost the full catalog is available as ebooks. Yeah. You can just do it that way.
That's where I write my newsletters.
At your library?
At my public library, yeah.
Wow.
I guess I'll let the world know. Yeah, I love my public library.
Go find Saz at his local Long Island public library on a Sunday.
How much was the book allowance? What are these guys pulling in about $1,000 a year for a book allowance? I mean, that adds up. What are you doing, Jeff Lawson? Come on.
We have to do some more digging on that front to find out. I mean, not to make fun of the book allowance. Obviously,
take away the hot dogs too. When you cut 30% of your workforce, just cut everything and start, I don't know, running a business. You shouldn't be laying off 30% of your workforce here.
It sounds like that's what they're doing.
So they're cutting the hot dogs too?
I don't know about that. I don't know about anything
I don't mean to laugh, but
I'm just
tired of hearing these large layoff announcements. And yes, the economy is slowing, but I mean, this is just bad management. Now you're overhauling your businesses too. What about
the companies that laid off people and then had Super Bowl ads?
Well, that too. I mean, that's just,
We're going to talk
you're living
more
in a
about
different
that
planet somewhere
later
with
in the show. But right now, we've got the opening bell,
yes,
don't we, Sus?
Yeah, we do. There's the opening bell on Wall Street to kick off a very busy week here, Julian Hyman. We have retail sales, we have CPI, we have earnings from Coca-Cola, Marriott, you name it. This is going to be a big week on tap. And of course, that inflation print, top of mind with everybody on Wall Street, because of course, we've been hearing a lot from Fed members, Jerome Powell talking about disinflation at the last Fed meeting. You've had various Fed members now walk that back last week, saying perhaps rates may have to stay higher for longer. Lots for the market to digest.
Yes, indeed, lots for the market to digest. And as we take a look at the opening bell here, we've got all three major averages that are in the green after the down week that we had last week, which was the first for the year. And as we get underway this morning, and I'm here at the Wi-Fi Interactive, we're taking a look at the Dow. I just took it over the past 7 days so we could see that decline that we saw over this period. So over the past 7 days, we're down about 0.5%. Today, up less than 0.2%. The S&P 500, similarly there, we have seen that drop over the past 7 days. Today, bouncing a little bit, the Nasdaq bouncing a little bit as well. So, you know, this sort of sideways period that we just kind of heard Young Yuma talk a little bit about that we have been watching. Let's see if we can call up some of the Nasdaq 100. Oh, there we go.
Hey.
And we've got a mixed picture as we look across different stocks here. Tesla shares trading down by more than 1.5%. Microsoft up more than 1.5%. So we're not necessarily seeing a uniform move in large cap technology this morning, but we have been watching what's been going on there. We've been watching crypto as well. We're going to get into that a little bit later. We are seeing Bitcoin prices trend lower, but we are seeing in terms of some of the crypto stocks, some declines there. So we'll get into the reasoning behind that in a moment. And then one more thing I wanted to check on here this morning, if I can find it on the many pages of our wonderful heat map here, and that's the AI stocks, because we initially in the pre-market had been seeing some of these guys bounce back. We are looking at an intraday chart, but some of the AI stocks are coming back a little bit today, but not all of them. C3.ai is down about 2% today. We were seeing a lot of these stocks come down at the end of last week after the big surge that we have seen for them this year. And some of them were coming back in the pre-market, but it looks like that move is not necessarily continuing. We are, by the way, going to talk more about AI later in the show, Saz, with Eric Brynjolfsson, who's an academic who's written extensively around ethics of AI and just the development of AI. So that should be an interesting conversation.
I am absolutely excited about it. I cannot wait to talk about that. Also excited about this one. Shares of Fastly surging to the green. That's what usually happens when they surge after Bank of America Securities upgrades the stock to a buy from underperform. The price target for Fastly also getting boosted from $10.50 to $16. Suggesting 27% upside from current levels. Good call, interesting company. B of A saying investors should get in on the ground floor, calling out the potential for revenue acceleration, more diversified products from this company due to a new CEO who came over from Cisco in September, and potential margin expansion as the company undertakes all of these things. This is a pretty good note.
Yeah, and to get the two-step upgrade, which is relatively rare here, right?
Boom.
The stock up and are we going to take Saz on camera doing his little?
That's what I do. That when you get the double upgrade, you get the boom from me. You get the boom. There we go. The boom. There we go. That's the double upgrade.
That's the double upgrade symbol, apparently. A couple other things to note when it comes to Fastly. The company is reporting its results on Wednesday after the close of trading. It's down 65% over the past year. It's up about 20% year to date here. So definitely some anticipation, some optimism. By the way, the new CEO's name is Todd Nightingale.
Oh, I love that.
Which is,
I love that. That's great.
That's the guy.
How do you not bet on someone named Tom Nightingale? I mean, this is great.
I guess you do, according to the people over at Bank of America. Here, too, by the way, cost reduction is part of the story, as it is for so many companies right now. And so that's something that the note is calling out as well. Slower infrastructure build out, the implementation of capacity forecasts should give a boost to gross margin, according to Tal Liani and the team over there at Bank of America.
There we go. I love seeing upgrades before a company reports earnings. As an analyst, as a former analyst, I just love seeing those things. You're putting your stake in the ground. Chances are you have some really good research and insight into that particular company, and you're willing to make a call. I dig it. Good for them.
Well, you know another company reporting after the bell on Wednesday? Mm-hmm. Zillow.
Oh!
And it's also getting a call today. It's on the move. It's up about 3%. Evercore ISI, our pal Mark Mahaney over there, upgrading it to outperform from inline. The firm seeing tentative signs of a rapid recovery in the housing market. I would call this a little bit more of a controversial call because Zillow has been so beat up, because the housing market has been hurting, right? Because, yes, you're
too nice. You're too nice, Julie. I said Zillow's been a dog. I mean, this has been about a year and a half, 2 years of just constant underperformance and strategy shifts, and it's not just a slowing housing market. They've been really mismanaged. And I love Mark, but this is an interesting call and an interesting time, just given what we are seeing in the housing market. Rates are still going up, housing sales still under pressure, and it's just hard for me to imagine the first half of the year for this company is going to be any different than the second half of last year.
He thinks things will start to inflect in the second quarter, which is also seasonally when you tend to see the housing market perk up a little bit. The price target going to 61 from 34. Now, I have to admit, I at one time had a little bit of a Zillow addiction, right? Where I love going on there and looking at what's on the market. Yeah, or just looking
that's pretty cool.
Not just in my neighborhood, what's around. Do you surf Zillow ever?
No, because once I go down that rabbit hole, it's hard for me to get out. I take that energy and I go into Carvana. I just like looking for cars. Yeah, I just like cars. I like cars.
Yeah,
we're good. I get it.
Yeah, we each have our own.
We can't be the same people. That show wouldn't be fun if that was the case, Julie.
That is absolutely true.
All right, let's keep moving here. Coming up, crypto platform Binance finds itself facing more scrutiny. Yahoo Finance's Jen Schomburger is back with the analysis you need to have right now. Always lots going on in the crypto space, with regulators continuing to laser focus on the sector. Some notable news out of Binance this morning. Let's get to Yahoo Finance's Jen Schomburger. Jen.
Brian, crypto firm Paxos has been ordered by the New York Department of Financial Services to halt creating new units of Binance's stablecoin, just as Paxos is reportedly facing a lawsuit from the Securities and Exchange Commission over Binance's coin. The Wall Street Journal reported on Sunday that the SEC told Paxos that it plans to sue the company for violating investor protection laws. The notice reportedly alleges Binance USD, a digital asset that Paxos issues and lists, is an unregistered security. Paxos and Binance entered into a partnership to launch Binance's stablecoin known as BUSD in 2019. The stablecoin is wholly owned and managed by Paxos, which has assured that all funds are safe and fully covered by reserves in their banks. Paxos will continue to service the product and manage redemptions. Paxos saying in a statement to Yahoo Finance, BUSD will remain fully supported by Paxos and redeemable to onboarded customers through at least February 2024. New and existing Paxos customers will be able to redeem their funds in US dollars or convert their BUSD tokens to Pax Dollar, a regulated US dollar-backed stablecoin that's also issued by Paxos. Now, Binance, for its part, saying in a statement to Yahoo Finance, quote, given the ongoing regulatory uncertainty in certain markets, we will be reviewing other projects in those jurisdictions to ensure our users are insulated from further undue harm. Now, the SEC does not comment on possible investigations. We do know that the commission is scheduled to hold a closed-door meeting this Thursday on enforcement action, where it very well could take action against Paxos. The SEC has been on a blitz this year when it comes to enforcement actions against crypto firms, having brought 4 already. We know that Chair Gensler is expected to be hauled up to Capitol Hill to testify before House Republicans on the SEC's actions in the crypto sphere. And so Chair Gensler likely to point to many of these enforcement actions. Now, we will have so much more on crypto, the outlook for crypto, the regulation landscape, and so much more in our 11 o'clock show with a crypto special. Brian?
Yeah, Jen, I'll tell you, can you just talk to us a little bit more about the implications of this or the context for this, like what it means that they're doing this, what it means for people who are on the Binance platform, or their concerns more broadly about not just these stablecoins, but about Binance more broadly as well?
Well, I mean, in this case, it appears that Paxos and Binance are assuring customers that if you do hold this stable coin, that you will be able to redeem it 1 for 1. And if you look at the action today, the trading action, it's not really sinking so much in value. So this is more just about shrinking market cap is what we'll really see at this point. Investors probably not going to be harmed as much. On the Securities and Exchange side, they are viewing this as a violation of securities law. So that's kind of a whole different camp right there, where the SEC is trying to use its authority that it already has to enforce the law to protect investors.
Gotcha. Jen, thanks a lot. Appreciate it. And as Jen mentioned, stay tuned for our special coverage on the crypto sector. It's coming up this morning between 11 and 12 Eastern. Brad Smith and Rochelle Akufo are going to have you for the hour, including a conversation with the CEO of Grayscale, Michael Sonnenschein. Stay tuned for that.
The tech layoffs continue, the latest ones being Zoom and PayPal. Our chart of the day shows how some tech companies have let go a substantial percentage of their workforce. Again, some pretty big numbers hitting the tech space in terms of layoffs. Coming up, Russia is cutting back on oil production, while our next guest says this will more likely be a necessity. That's on the other side of the break.
Russia is cutting back on oil production by 500,000 barrels a day beginning in March to counteract sanctions. Our next guest says while the cuts are being positioned as a choice, it's more than likely a necessity. CIBC Private Wealth U.S. senior energy trader Rebecca Babin joined us now. Rebecca, it's great to see you. So this news came out and the oil market didn't necessarily react as much or like one would have expected. Can you walk us through what the market was expecting from Russia and how it's being read?
Sure. So the market was pretty ready for Russia to cut production in the start of 2023. Alexander Novak, the energy minister in Russia, had indicated in late December that they were going to cut production by 500 to 700,000 barrels in the beginning of the year. Now, Russia, as you mentioned, is positioning this as a choice. We are cutting this production to punish those who are imposing price caps and sanctions upon us. And I think that's a way to kind of get the market to move higher so that they can sell fewer barrels for more money and hopefully make up the revenue. The reality is they're probably having a hard time moving these barrels. And this is because as we moved forward into the February 5th sanctions package on Russian products, we're bumping up into a smaller markets for Russian products and fewer tankers that can actually ship products. So if Russia can't move its products effectively, it needs less crude oil demand to feed into its refinery and therefore has to cut production. Almost every analyst on the street has been penciling in at least 500,000 barrels of Russian production cuts in 2023, and most are looking for closer to 800,000. So this was a confirmation of what analysts had expected, and if we hadn't gotten it, the market would have been off harder. And it is an incremental positive that they cut production, but I think the market expected it and is needing to see more to really keep the production side of the story alive for crude.
Rebecca, what's more top of mind with investors in the oil patch right now? Is it these Russian cuts, or is it the chance of a mild recession in the U.S.?
Good question. I think it's the chance of a mild recession in the U.S. The Russian story, if we kind of reverse back to 2022, it was a supply-led rally, and it faded hard into the end of the year. It seems that the market is going to reward demand-driven stories much more than it's going to worry about supply. Russia has found a way to find end markets. The market is efficient enough that if the price is right, product seems to find a home. So demand is really going to be where the conviction lies. And if there's a little bit of a question about where U.S. demand is going to be or European demand, it is going to create some downside risk.
And what about Chinese demand, right? Where do you stand on that? Because that has also been a big question and a big pivot point for oil over the past year.
So that is the center point of the bull thesis, is Chinese demand rebound in 2023 for crude oil. The swing factors I'm seeing are it could be as big as 1 million barrels of demand, incremental demand, to as much as 3 million barrels, depending on how the reopening plays out. It's underpinning every bullish trade on the street is Chinese demand. It's the story, the one thing, if there's only one thing to watch in crude oil, it's Chinese demand. It's less about the recession in the US. It's less about Russian supply. It's Chinese demand. So I think when we look at what's happening in the market, we're seeing a market that's really anticipating this, and we are seeing incremental demand from China, but it's not linear and it's not quite as fast as the expectation maybe is. So we're not able to break out of this current trading range until we really see in the physical market some tightness coming from Chinese demand. That doesn't mean it's not coming, and I think that it is, but the magnitude and the timing of it is what keeps the market on its toes and trading with a lot of volatility.
We've seen gas prices really continue to ease here. Do you think that's mostly due to demand destruction, meaning that consumers have been dealing with these high gas prices for 6 months, maybe in more than a year in some cases, and they're finally starting to drive less and pull back?
I don't think it's that. I mean, I do think there's been some softening in demand. If you look at the weekly numbers that are highly volatile that come out, it has come off a little bit. I don't think it's necessarily this behavioral change. I think it's a little more seasonal. This is not a seasonally strong driving period per se. So the numbers I can see why gas prices have come off. And frankly, we've had some builds in inventory over the last month, just as we've been able to kind of have some refiners doing, coming on, doing their work, importing some, importing some gasoline, and that's really alleviated some of the pressure on the prices at the pump. I don't think it's demand destruction.
Do you think they're going to last and stay down?
So I don't think they're going to stay down for the summer. I think we're going to see another uptick and potentially a spike over the summer. And the reason for that is that's going to coincide with when Chinese demand is really ramping. So I don't think we're set up for a really quiet, easygoing summer on prices at the pump. So I would enjoy it for now and prepare for higher prices in the summer.
Noted. Saz will be filling up the gas cans for his garage.
Yeah, nice V8 gas guzzlers. Let's go. There we go.
CIBC Private Wealth U.S. Senior Energy Trader Rebecca Babin. Rebecca, thanks a lot. Appreciate it.
Thank you.
Coming up, fielding the Super Bowl ads, we'll break down the winners and losers from the big game. Companies pulled out all the stops for Super Bowl 57 ads, using celebrity star power to elevate themselves, with Fox saying they pulled in record revenue from companies for this 30-second spotlight. Let's break down some of the winners and losers of the night. Saz,
I will start with Google Pixel. I think their commercial on the Magic Eraser, I put out a question on Twitter after I saw the ad, and I'm like, I guess I should maybe get a Google Pixel now. The ability to take out these photos, it's pretty cool. I can't do that on my iPhone, so for me, I think that was a win. And then somebody, of course, tweeted at me. They would argue that maybe some of these things are even worse, but for me, I like this, and it makes a lot of sense. Come on, Apple.
I mean,
you don't want that guy in the bikini in your photo.
But I don't know. I have a problem with this actually, from a sort of existential, This is again the whole thing, the whole swing towards deep fakes and this is what happened.
Wow.
This is reality. This is what happened in the photo.
I knew it.
That's part of the memory. Why would you want to get rid of it?
When
It's
I
weird.
saw that, and that was my second thing here, when I saw that last night, I knew you were not going to like it.
I think that's
And that's
weird.
why I brought it up, is reason why I liked it, because I knew you weren't going to like it.
And P.S., you're not buying a Google Pixel.
No, I'm
Who
not
are you
buying. That's the other
kidding?
problem. I love my
Who are
iPhone.
you
I'm not using
kidding?
a Google
People
Pixel.
aren't buying the Google Pixel.
Come on
Get
now.
out of here.
Come on.
I apparently was the only person who saw a Meta ad for Horizon
I can't
World that I
find it.
thought was terrible. It just wasn't a very well executed ad, and they're doing it on the back of laying off all those people. So I didn't love that. We couldn't even find video for the ad because I don't know if it existed in my brain
It was a
or
deep
what.
fake ad.
Maybe it was a deep fake ad that only was beamed directly to my television. I have no idea. I thought one of the really interesting ads was from a platform that's owned by Pinduoduo, the Chinese company.
Jared Pickle loves that stock. Always following.
This was a fast fashion ad. I don't even remember the name of the website that they owned that they ran this ad for, but it was sort of like, what was it? Shop Like a Billionaire or something?
Was it $8.99 close or something?
Something like that. It was like ridiculously cheap. There's the ad. I'm not a big fan of shopping in this way because I
Yes.
think frequently if you get what you pay for, and if you're buying something
It's
for
also massive
$8.99,
waste.
like this, yes.
It is massive waste,
Correct.
and these companies still have not dealt with it. Now, besides Pinduoduo, the winner here really is probably Apple in the halftime show, and all the chatter this morning about Rihanna, that is more impressions for Apple. Of course, this was their first Super Bowl halftime show. It's always been sponsored by PepsiCo. Good show by Rihanna, of course. The internet now on fire. Is she pregnant? Wasn't she pregnant? But she is pregnant. Yes, she confirmed.
She
So,
confirmed
yes.
that
So,
she's pregnant.
Big win for Apple. Unclear if I'm going to sign up for Apple Music. Sorry, Brad Smith. I'm just a Spotify guy, but nonetheless, a good win for Apple here.
You're not getting the Google Pixel phone. You're not signing up for Apple Music.
But I can opine on these
ads-
things. I can opine.
You didn't really work in that way,
Yeah.
I guess. All right, coming up.
I just erased you. you.
No erasing me, buddy. It's a big weekend for earnings. We're going to break down the top companies you should be watching next. Plus, stay tuned for our conversation with Expedia CEO Peter Kern. That's later on in the hour. We'll be talking about the state of the travel industry. And by the way, we'll be looking ahead to Airbnb earnings as well. Keep it right here.
Welcome back to Yahoo Finance. I'm Brian Sozzi here with Julie Hyman. Markets are eyeing a busy week of econ data, notably the Consumer Price Index and retail sales. Right now, you're seeing markets taking all of this market-moving data in stride here. You're seeing the Dow up close to 200 points. We'll get set up for you. Big earnings reports out from later this week. Coca-Cola, Airbnb, Marriott, and other companies as well. We have everything you need to know. And make the bad news disappear. Beat up Snap investors are prepping for a key investor day this week. We have a preview, and here comes vacation season. Expedia CEO Peter Kern stops by following his company's latest earnings. Julie, over to you.
Yeah, let's talk about what stocks are doing here, because already out of the gate, we are seeing stocks take another leg higher. That means the Dow right now is up about 0.5%. The S&P up better than that. And the Nasdaq is leading the pack here. It's up by about 0.8%. We are seeing that inverse relationship between stocks and bond yields, particularly when we're talking about those large cap tech stocks. Bond yields are coming down today. That means there's more optimism maybe about what the Fed's going to be doing and how aggressive or not it is going to be. And so we are seeing the 10-year yield at 3.72%. Elsewhere, as we take a look at the sectors within the S&P 500 here, energy is the only one in the red. We were just talking a little bit about oil prices with Rebecca Babin of CIBC. We've got tech stocks, we've got real estate, we've got financial, communication services. Almost everything is up today, and it's sort of mixed in terms of what types of groups are up. Interesting, for example, to see real estate and tech both up at the same time. So interesting trade that we are watching there. And then excuse me, to go back to the Nasdaq, big movers for a second. Tesla shares standing out to me. They are down by more than 3% today. We're going to talk a little bit more about Tesla. And by the way, its role in the big game, not the role you might expect. You might have seen Elon Musk sitting there next to Rupert Murdoch at the game. I don't think that's why the stock is down. We'll talk about it a little more later. Microsoft, one of the stocks that's helping lead the gains today, it's up about 3.7%. I did see some more analyst chatter about the prospects for earnings growth from the company. So interesting there. Economic data, meantime, is front and center this week, where we'll not only get the latest inflation picture, but also some insights on the state of spending. Here to break down what to expect for this week's retail sales numbers for the month of January and inflation, Yahoo Finance's Alexandra Semenovas with us. Hey, Alex.
Hey, Julie. So retail sales is kind of in the shadow of the CPI report, but it's still an incredibly important report for investors this week. The headline figure is expected to come in at 1.9% in January per Bloomberg estimates. That would mark a major rebound from a 1.1% drop during the prior month. Data from the Commerce Department has shown really strong credit card spending in January. However, the magnitude of that strength is partially attributed to a seasonal distortion in the data. Basically, since the start of the pandemic, consumers have been front-loading their holiday shopping, so we don't get the strong figure that we've been getting before in December, and then an exceptionally strong figure in January. So if you look at the past few months from November, December, January, it's kind of leveled out. Still really strong consumer spending, though. That's how Bank of America explained it. They also attributed the pickup to consumers kind of waiting for post-holiday clearance sales, so that might be lifting the retail sales figure higher this past month. Another reason for the strong retail number is continued momentum in the labor market. You know, consumers have jobs, they have more disposable income. That's also driving the number higher. And another thing worth flagging is everyone talks about strength in the labor market as a reason that we might not get a recession this year, but it's also strength in consumer spending that's really been holding up economic momentum. We've seen people still spending money even in the face of inflation and higher interest rates.
And speaking of inflation, of course, big CPI, the market is very focused on that and what it may or may not mean to the Fed.
Yeah, exactly. So stocks have had a strong start to the year, and partially a reason for that was expectations that, the outlook for interest rates isn't as hawkish as some officials said that it was. Investors thought that the Fed might pause and even cut rates this year, but that outlook has really shifted in the past week. One, because of the really strong January jobs report, and two, after Powell's comments last week. Last week, the CME Group's Fed Watch tool, which measures market expectations for the federal funds rate, had rates at the end of the year at 4.5 to 4.75%. That's where they are right now. And in the past week, the highest probability now stands at 4.75 to 5%. So markets are actually starting to take Fed officials for their word that we're going to go to 5%, maybe even higher. And tomorrow's CPI report could really assert this more hawkish view. Now, the question is not about the inflation picture not improving. It certainly is, but it's just not improving at the pace and extent that some people have been hoping for.
Great analysis here, Alexandra Semenova. Appreciate it. Thank you.
Thank you, guys.
All right, with ChatGPT taking the world by storm, the spotlight on artificial intelligence is brighter than ever before. What exactly is the scope of AI, and what are the implications that lie ahead? Here to discuss is Eric Brynjolfsson, Stanford Digital Economy Lab Director. Good morning to you. Before we even get too deep down this rabbit hole, what is the difference? What is making this crop of AI different than in years past? And how does it compare to, let's say, even an algorithm? I think there's a lot of confusion out there.
Sure. Well, ChatGPT is an example of a new class of AI that is, I think, a really big breakthrough. These are called foundation models. They include not only large language models that can write stories, poetry, email, ads, many other types of text, but many of you have probably played with DALL-E that make images, others that make videos, audio, even write computer code. These tools are having a set of implications that I think are bigger than even their developers expected initially. Trillions of dollars of value will be created.
And Eric, you've written about, there's been a lot made of, and a lot of, I think, fear out there, as well as excitement over what these new developments can mean. You've written about what you call the Turing trap, one of the potential things that we need to watch out for. Can you explain that to people?
Sure. Alan Turing famously proposed that the test for intelligence was what we later called the Turing test, which was how similar can an AI be to a human? And trying to mimic humans has been kind of a goal of a lot of computer scientists ever since. Can we fool humans so you can't tell the difference? I think it's a very evocative goal, but it's also a trap. And the reason it's a trap is that if we make AI that mimics humans, it actually destroys the value of human labor, and it leads to more concentration of wealth and power. But there's an alternative approach, which is making AI that augments humans, that allows us to do new things we never did before. Don't try to mimic us, but try to extend our capabilities. AI that does that is more likely to lead to a flourishing of wealth and more widely shared prosperity.
So where the industry is going now, which of these things is the goal? In other words, do you think that some of the goals are sort of on the wrong path right now?
They sometimes are, although I'm actually pretty optimistic. I've seen lots of good uses of these tools to even enhance invention and innovation. People are using them to invent new compounds. I was talking to a colleague, and one of his grad students had written up a research proposal, and he couldn't quite make sense of it. And then he ran it through ChatGPT, and he said, that's what she was trying to say. And he showed it to her. He said, yeah, that's what I was trying to say. I think there's a lot of people who have some brilliant ideas. They have trouble expressing them, and these tools can be used to help make it more possible for others to get what they're trying to say.
Eric, we were talking about today the new Pixel phone, the Super Bowl ad, where the magic eraser, where you can erase somebody or an object from a photo. Is that tech for good? And what is the societal impact of something like that?
I'm really worried, not just about that, but more broadly, deep fakes. Just over the weekend, I saw the first deep fake in the wild. There was an ad running on TikTok where some famous people were saying things that they didn't really say. And it was impossible to tell the difference. So this is going to proliferate as the cost of making deep fakes goes down. The number of them is going to increase exponentially, and we're going to have to come up with some ways of understanding what's real and what's not real.
This all seems to be moving so fast. I wonder if, that a lot of that stuff is going to fall through the cracks. In other words, like you say that we have to sort of be prepared for deepfakes. It doesn't feel like we're prepared for deepfakes.
No,
it doesn't feel like we're prepared for some of the other pitfalls you're talking about.
I totally share your concern. The technology is racing ahead, and the next 10 years could be some of the best 10 years we've ever had or some of the worst. But we have to adapt our institutions. One of the reasons I started the Digital Economy Lab here at Stanford was to try to close that gap, to study the economic implications, the societal implications, and we need to hustle to catch up. I'm proud of my colleagues, my very smart colleagues that are inventing these amazing technologies, but the rest of us in business and economics and social sciences need to get on the ball and think about how we can make sure our society is ready for these changes. If we do it right, I do think that we're going to have unprecedented productivity and growth, and we can have shared prosperity, but it's far from inevitable.
Eric, I think investors have just sent a lot of these AI stocks through the roof. If they bought one of these stocks, let's say a C3 AI, if they bought one of these stocks because of announcement of AI, how does AI impact their bottom line? Is it a one-time shot? Is it a jolt, or is it just over time these companies will just see just a faster rate of earnings because of AI?
Well, we're in very early days. I mean, there's been a one-time shock, but then there's going to be another one-time shock and more shocks coming in the pipeline. I already know that there are new versions of these large language models that are set to be released shortly that are dramatically better even than the ones we've already seen. They're being used in lots of other applications. So we're like in the first inning of this, and the winners right now may or may not be able to extend their lead. It may be that a whole different set are going to emerge. I see a lot of turbulence.
Now, I know you're not coming at it from an investment perspective, but I do wonder, for lay people out there who are buying up AI stocks right now, is there any kind of lens that they can apply or analysis they can apply without being super steeped in it to know who are going to be the winners and losers in this thing?
Ironically, I think it's almost easier to see the losers than the winners. A lot of legacy companies that were relying on just the old way of doing things, their value is going to be threatened. Some of the movie studios or others that have amazing content creation capabilities, they're now going to become stranded because we can do them much more cheaply and do them in new sorts of ways. It's a good bet to focus on companies that have some of the best talent and have some of the best resources. Here, within a few miles of my house here at Stanford, there are dozens or hundreds of companies that are tapping into this, and I see a number of years of very fast innovation in this field.
Exciting times indeed. Eric Brynjolfsson, Stanford Digital Economy Lab Director. Good to see you. Appreciate it.
My pleasure.
Before we head to break, let's pull up shares of Target. The company will hold a key investor day on February 28th, and Guggenheim retail analyst Robert Durbel is a little worried on what investors may hear. Durbel slashed his 2023 profit estimate on Target by a whopping 95 cents, says Durbel. We believe Target will likely continue to feel pressure in its discretionary categories, such as apparel and home, with its middle-income consumers, and the ensuing mix will continue to pressure both comps, or comparable store sales, and gross margins in the near term. Coming up, we'll get a pulse check on Airbnb ahead of those earnings tomorrow with Needham's Bernie McTernan. That's next.
Needham is reiterating its buy rating on Airbnb, citing strong signs of demand despite fears of peak travel. Airbnb, by the way, reports its earnings after the close of trading tomorrow, Valentine's Day. Let's get to Needham Managing Director Bernie McTiernan for more on this bullish call. Hey, Bernie, good to see you. So, as we try to figure out kind of where we are in this travel cycle, where does Airbnb fit in?
Yeah, no, that's certainly the key debate on shares on if we're at peak travel or not. What's interesting to me is that we had Expedia just report. They called out, even though the reported numbers were impacted by the hurricane, the organic trends were solid, with demand accelerating throughout December, importantly into January as well. Google also talked about travel supporting their search business. So that's the key debate on shares is are we at peak travel on the other side of it? It seems like we're still in this wave where we're not there yet, but that's certainly what investors and the bears are focused on, just because the massive shift in ADRs that have happened. So as demand starts to fall, you could have the snowball effect that impacts ADRs, that impacts gross margins, and flows through to the bottom line.
Bernie, do investors also want to see cost cuts from Airbnb, and do you anticipate them?
I don't. One of the amazing things about this company is just the belt tightening that they've kept from the pandemic. They had major cost cuts happen in 2020, and that's the reason why they have 30% EBITDA margins now. They have $3.3 billion of trailing 12-month free cash flow. They're buying back $1 billion of stock. I mean, one of the quite honestly simplest questions we get about our coverage is this a good company or not? And Airbnb is undoubtedly a good company that was structurally transformed by the pandemic. And again, this belt tightening that they did, they've kept it through, allowing margins to flow through. So not expecting, any additional cost cuts from the company, and because the great job that Brian and team have done.
What about all the tweaks that they've been doing, both for hosts and for people staying at Airbnbs, right? It feels like there's been a lot of sort of rejiggering at the margins. Is that mostly been in a positive direction? Is there one thing you can pick out that's sort of been most helpful for them?
Yeah, no, I think the categories that they've launched is really interesting. And so what categories is that you say, okay, I want to stay at a beachfront or ski on, ski out. So you start there instead of saying I want to start in Tahoe and then go from there. Why that's interesting is that it allows Airbnb to better push demand to where they have supply. Ultimately, longer term too, I think this is a really interesting opportunity, because as the consumers journey, let's say, for booking travel starts at Airbnb, then there's all these other opportunities that, they can act as a retail media network. And, you can book your travel through Airbnb, book more experiences through Airbnb. Maybe that's what unlocks this experience opportunity for them as well that they speak about. So I think categories is really interesting. And I think it's a great consumer product as well, too. I've really enjoyed every time that I've used it.
And Bernie, how does a recession impact Airbnb?
Negatively, right? If that would be the peak travel fears, is that we're on the other side of it. So another thing that we're focused on is supply. And I bring this up because on Uber's earnings, both Uber and Lyft, they had record supply and record drivers on their platform. One of the things that Dara spoke about was that the increased supply was actually in response to inflation and consumers needing, that platform. Airbnb, their supply accelerated last quarter to plus 15% year over year. So I wonder if there is a counter-cyclical nature in terms of supply where you could have actually more supply come. So even though you'd have the demand hit from a recession, if it could be helpful for supply and make the platform stronger. But look, this is consumer discretionary spending. So that would be that peak travel fear bearing out, and that estimates are just way too high if we are heading into recession.
Hey, Bernie, just to put a fine point on it here, you obviously have a buy rating. You would recommend buying the shares going into the earnings report, I assume.
Yeah, I mean, look, it's not a short-term call. We have a buy rating. Those are 12-month price targets. I look at a company that's trading at 22 times our 23 23 EBITDA estimates. I think that, there's still a lot of upside there if you think about that this company will continue to grow. So I think this is frankly one of the best companies that we cover. And so this isn't a short-term call, the buy rating. It's more, this is a longer term. This is a secular grower that has years of runway in front of it, even though bookings from 2019 to 2023 are going to double. There's still a long way to go to impact this $1.5 billion or trillion dollar travel TAM.
Nita, Managing Director Bernie McTernan, always good to see you. Good luck on that call tomorrow night.
Thanks, guys.
All right, and stay tuned for our special coverage after Airbnb's earnings call tomorrow, where Brad and I will break down all the top headlines. You won't want to miss it, and you better be there because we're both canceling our Valentine's Day to be there for you, John and Jane Doe investor. All right, as earnings season begins to wind down, investors will be watching inflation data for clarity on the Fed funds rate hiking path. Yahoo Finance's Jared Blickery has all the details. Jared.
That's right. That big CPI print really going to be, I think, one of the biggest movers this week. We still have a lot of earnings, but let me take a look at the market where we are right now. One of the things I'm noticing, the Nasdaq once again leading over the Dow. Now, this has been the trend this year. Tech stocks, which were flagging last year, the Dow was outperforming. That kind of switched this year, except that last week it flipped again. So let me just show you where we are year to date in the Dow. Here's what we're doing today. Here's year to date, not even up about 3%, although you can see it's been maintaining its gains for several weeks. Now, here's the Nasdaq. Nasdaq is up 13%. The reason leadership matters is because we've seen a number of leadership changes over the last year, especially when the Fed became more hawkish. Now, here is the S&P 500. This is over the last 6 months, and we are in an uptrend. This means we have higher highs and higher lows, and here we are. And even considering the fact that we still have to take out some highs from about 6 months ago in the August-September area, around 4,300, still in an uptrend. In fact, I could make the argument that this is a bull flag right here. So until proven otherwise, still in an uptrend there. Let me just take a look at the bond market. We have 10-year yields flagging just a little bit today, down 3 basis points, but the recent trend has been up. And what's interesting about that is that that usually hurts growth stocks. And in fact, that's what happened last week. Those tech stocks that have been leading this year, they took a back seat last week. So we want to see if that's going to continue. Let's take a look inside the market here. Here's what's happening today in the S&P. Tech leading, Staples, XLP also outperforming, financials, real estate, communication services, all of those outperforming. Only energy, which was last Friday's winner, that's the only red spot we have right now. That's down about 1%. And finally, here's the Nasdaq 100, just showing the mega caps here. Microsoft in its extending its lead over Alphabet in the, I guess we're going to call them the AI world, the AI wars here. Microsoft up 3%, Meta up 2%. Some Chinese stocks making some gains here, but all in all, not a huge day for most of these tickers.
Jared Blickery, thanks so much. Coming up, it's vacation planning season. Expedia CEO Peter Kern joins us next for his outlook on all things travel. We'll be right back. It was a mixed quarter for Expedia, with the travel booking platform citing struggles from severe weather, which impacted demand and dragged down the company's momentum. Expedia did note that demand bounced back in January. Very important there. Expedia Group CEO Peter Kern joins us now. Peter, always nice to get some time with you. Let's lock in on January. What did you see trend-wise? And then have you anything you could share on how February has been shaking out?
Yeah, I think, Brian, excuse me, we've seen really nice rebound. You know, we were seeing accelerating demand through the fourth quarter. It's just that it got hit particularly hard in the last few weeks as the storms came through, and we're very weighted towards North America, and that was a big hit for us. But demand was growing through the fourth quarter, and we saw kind of a step change into January. And so far through the beginning of the year, it's been pretty strong throughout. It's not just a January thing. And, you know, it's global. We've seen it in many places. We've seen it driven by lots of categories. International continues to grow. And remember, we're seeing a time where last year, this time, a lot of things weren't open yet. So things like cherry blossoms, international events, things like that are still growing. And people are getting back to that in a pretty robust way.
And where is China playing into this comeback?
Yeah, I mean, China's really not going to be, I don't think, in anybody's numbers in a strong way, meaningful way, until probably the latter half of the year. There's tons of demand. We're seeing lots of searches. We're seeing lots of searches in and out of China. We have B2B partners in China that are very important to us. But because of the flight lanes and how much airlift there is, it's still somewhat limited. There's a lot of rules, as you've probably heard about, in terms of getting in and out and testing for Chinese residents going into other countries. So there's a lot of demand, clearly. There's a lot of interest. But I think until the planes start going and we start really seeing that demand, a lot of demand's a little ways out. So it'll come through the numbers, I think, more in the back half of the year. But it's definitely growing. And Asia overall is growing as more and more opens up. And it's outgrowing kind of the rest of the world right now.
Hey, Peter, it's Julie here. What's sort of the biggest change that you've seen in the past 6 months? Whether it's where people are going, the length of time they are staying, et cetera. What kind of stands out to you?
Yeah, I think we're seeing some of the things we've talked about before, which is kind of normalization, which is to say, you know, this time last year, it was Omicron. And so everybody loved Vrbo's and other vacation rental properties at other of our competitors. Now we're seeing a much more normalized mix towards resorts, hotels. Big cities are back in a big way. All the biggest, you know, what used to be true, which is big cities sort of commanded the most search, is true again. So I think you're seeing kind of normalization back to big cities, normalization back to international travel. You know, there's a little less, we're seeing a little less of these long stays where people were, you know, never going back to the office and going to stay forever at vacation rentals. I think we're seeing a little normalization of that too. Still lots and lots of travel, but just a little bit more normal mix.
And I know you guys have been working on customer and user loyalty, right? Have you found that customers are pretty fickle? They'll jump around looking for the best deal. What are they prioritizing right now?
Yeah, I think, you know, there's always going to be a class of traveler who maybe wants to save the last dollar and doesn't care who they book with and doesn't care what the service is. But we believe that travel is really precious time and that people generally care deeply about doing it right. And so we've been highly invested in improving the shopping experience in terms of knowing what you're getting, ranking all our suppliers in terms of the quality of their experience, giving customers more tools to shop and better understand what they're getting. Because we believe, you know, most of us want to make sure we have the right trip, not just save the last dollar. And that goes all the way through to the shopping, you know, the in-trip experience and the service side. And we found that our, you know, our most loyal cohorts are the people we get into our loyalty program, people we get onto the app. And those have been our fastest growing cohorts during this last couple of years. So we're really excited about that. And we think the numbers, you know, are proving that out. So, you know, people do want to go trust their trip with somebody they trust, not just take a trip, in our opinion.
Peter, we've talked in the past about the turnaround that you continue to drive at Expedia. What inning are you in that turnaround, and what are some of your most just important goals for this year?
So I would say we're in the, you know, 6th inning, coming up maybe on the 7th inning stretch. Our big pushes this year are twofold. One, we're kind of finishing our big technical transformation. I mean, we're always improving our technology and adding features and capabilities, but we've been moving. We moved Hotels.com onto the same front end as Expedia. We're moving Vrbo in the coming months. And then we're launching our big all-up loyalty program called One Key that's going to span all our biggest brands and be the most flexible, biggest rewards program in the industry. So that's a really big push for us that comes later this year. Once those two things are behind us, then it's sort of like the day-to-day, just improving and consolidating the back end. There's some efficiency opportunities there. So we're through a lot of it. And I said on our earnings, we're now at a point where we have more tailwinds from the things we've done than headwinds, but we still have a couple big things to do. But we believe we can drive really nice growth while doing those, as we have done in the past year.
Well, Peter, thanks for joining us this morning to chat about all of this. Expedia Group CEO Peter Kern, happy travels to you.
Nice to see you. Same to you.
Thanks. Coming up, the latest news out of Snap is leaving investors skeptical. The company's going to talk directly to them, and Saz has got a take next. A snapshot of what to watch. Chilly forecast and falling revenue at Snap, giving investors pause. But pay attention to what's said and not said during the Investor Day, which is just about to happen. And that's where we find Sazi's take.
You know me, I love me some Investor Days. Big fan of any type of Investor Days. A couple things to watch here from Snap, which is out of stock that has been absolutely obliterated over the past year, despite them canning 20% of their workforce a couple months ago. A couple good notes here from Brent Thill, who of course covers Snap, that he's watching. Number one, will there be any medium to long-term revenue or profitability guidance from Snap? He mentions that in February 2021, that Investor Day, they announced medium-term revenue guidance of 50% plus growth. Brent doesn't think you will see any form of guidance from this company on Investor Day, and rightfully so. The results have been dreadful. The market is very challenging for ads. I'd be shocked if you get any form of guidance in terms of short-term, medium-term, or any term guidance from Snap. Next up here, he's also looking for how long will it take for recent improvements to the ad business to drive revenue growth. Snap has been investing in better technology here. Investors are still looking for a return on that investment. And then also a couple more nuggets here. How can Snap reverse declines and time spent in a more challenging competitor environment? Unclear how they will go upon doing that. They didn't sound like they had a very clear answer for this when they reported earnings a couple weeks ago. And then why are they losing eyeballs? It just continues to be TikTok. TikTok continues to be mentioned as an absolute juggernaut in all things social media, gobbling up eyeballs, not only from Snap, but of course, Facebook and Instagram. Brent did note that if there is a U.S. TikTok ban, it could be a $450 million or 10% tailwind to Snap's 2023 revenue. I mean, that is, I don't think baked into Brent's modeling here, but it gives you a taste of what could happen to a Snap and Meta and its various businesses if there is in fact a U.S. TikTok ban, because you would likely be unable to use it. So you go back on Snap, spend more time on Instagram. Overall, my take is this: as we go into that Snap Investor Day, which is February 16th, I can't wait. Something has to give with this company already. It has just been I would say just a series of disappointments for Snap over the past 2 years, ultimately leading up to them releasing or canning 20% of their workforce late last year to improve operating margins. They have to figure out some way, Julie, I think, to just better compete with TikTok. And to me, they have not served that up yet. Maybe there isn't a better answer.
Yeah, I mean, and nothing that you were laying out there really is something that you would think we would hear from the company as it tries to court investors, right? A lot of that stuff was sort of not happening or not very positive.
And what you're also now, I think, in a little bit of a pickle, not just with Snap, a lot of these tech companies, now that you've cut so deep, we were talking about Twilio earlier on, but you've cut so deep, 20% plus of your workforce, that has to have hurt morale. How does it impact revenue? Can you innovate at the same pace you have at the past? And if you can't innovate, how do you regrow your top line?
Yeah, all good questions for that Investor Day.
That's why I'm here.
We'll be watching it. Coming up, betting on the big game, how sports gamblers and companies made out after Super Bowl 57. That's next.
U.S. sports betting operations are edging toward profitability. And if you watch Sunday's big game, it may seem that sports betting operators are one of the night's biggest winners. For more on this year's betting trends, let's get to Citizens Capital Markets Head of Gaming, Leisure, Investment Banking, Christopher Lynch. Chris, good to see you here this morning. Any early takeaways on how a lot of the betting companies did for the Super Bowl?
Yeah, look, I think the outcome of the game was mixed. Certainly hit the over, and then I think the Chiefs were a good outcome for the teams. But the Super Bowl is all about customer acquisition, right? And that's why you see such a high level of advertising during the Super Bowl. It's the biggest acquisition event of the year, and all signs point to a very good outcome on that front.
I don't know. Maybe you can explain to me why I saw that Gronkowski field goal go in, and then the commercial said it didn't happen, which is still confusing to me this morning. I mean, how do you think the different betting companies did with that customer acquisition?
Yeah, I mean, they're trying to get creative, right? And they're finding different ways to attract and, more importantly, retain customers, right? We're hitting the point now where the industry is becoming more mature. It's not mature, but more mature in states like New Jersey, for example. And they're getting more creative with promotions to retain those customers that they acquired on a pretty expensive basis several years ago.
Out of everyone in the industry, which company is closest to profitability and why?
It's FanDuel by a pretty significant margin, and I think what you see with FanDuel is economies of scale. So FanDuel is across the board, the market leader, performs at a really high rate, and because of that, they benefit from economies of scale from national advertising and other benefits that they get from that.
Now, you mentioned the promotions and how they're sort of maturing. Does that mean we've seen the end of the sort of arms race of like them just throwing money at potential customers? You said they're getting more creative with the promotions. What does that mean for that whole cycle?
Yeah, I think a lot of that's market driven, right? The cost of capital for these companies has increased pretty dramatically from the 2020, 2021 timeframe that most people refer to when you talk about the arms race and the excessive levels of advertising. So as capital costs have gone up, they've had to become more prudent, more deliberate with the way they spend their capital.
Are these companies going to need more capital to fulfill their ultimate vision?
Yeah, that's the question the street is asking right now. Are cash levels across these companies sufficient to bridge them to profitability, bridge them to the point at which they can continue to self-fund themselves? Virtually every company will tell you yes. I think the one thing that can really move the needle on that are a couple of big states that legalized, as Texas legalized this year. We saw what happened in California. That could really change the equation about timeline to profitability and need for capital.
What are some of the other big things we can expect this year? Is it going to be, you mentioned Texas, is it going to be more states? Is it going to be new waves of new games, I should say, that are more coming to the fore? What do you expect?
Yeah, I mean, legalization's definitely slowed down. That's just a function of how many states have legalized, right? We're at about 35 states that have legalized in some form or fashion. I think that's going to continue to remain a focus, with Texas being the biggest focus. What the operators are really focused on this year is iGaming, more so than sports betting, and seeing additional iGaming states, because from an earnings standpoint, a profitability standpoint, iGaming really moves the needle.
Sorry, what do we mean by iGaming?
Internet gaming, slot machines, table games on your phone versus sports betting. And in a state like New Jersey, DraftKings and others are able to offer those side by side. In New York and other states, that's not the case.
What gets betting through or just into the end zone in Texas?
They have a lot of support from very powerful individuals, both sports team owners, and they're starting to build political support. Texas has looked at gaming expansion for many years, and it's historically a conservative state, and it's always been a high bar to get over. But it feels like with the momentum is building in that state.
Chris, we didn't ask you who your team was.
So I oversee the gaming and leisure investment banking practice at Citizens, and we've been
No, I mean what team you were in.
I'm sorry. So I'm a Giants fan, so I tried to forget about the teams in the Super Bowl already.
We can't root for the Eagles.
Look, I can't say I'm too upset about the outcome.
Gotcha. Okay, that's what I was saying. That's what I was interested in.
All right, well, fair enough. Good to see you here. Citizens Capital Markets, Head of Gaming and Leisure Investment Banking, Christopher Lynch. We appreciate the time.
Yeah, thanks for having me.
All right, meanwhile, electric vehicle makers gave it their all as well, pumping out EV ads for Sunday's big game. Stellantis, General Motors, and Kia all got some EV exposure. Yahoo Finance's senior auto correspondent, Praz Subramanian, has all the details. Praz, what ad blew you away?
You know, Saz, I know we're gonna drill down on a couple of those big ones like the Ram EV ad and also some stuff with Tesla. But, you know, overall, you know, yet again, we saw these autos and EV brands sort of littering the Super Bowl with more ads. Automakers love spending their ad budgets on the big game and what could be the most watched game of the year. You know, Edmunds reported that some of these brands are seeing a 90% lift on their website, like GM, you know, with the funny, why not an EV Will Ferrell ad with Netflix? You know, I don't really understand that ad, to be honest with you, but, you know, we saw some upcoming GM EV products there. Also, Jeep's electric boogie ad with animals dancing and celebrating the 4xe hybrids. You know, no EVs in that ad, but, you know, these cars aren't exactly the most green anyway. And Saz, you know, my favorite ad, I think, was the trailer for Fast 10. I'm a big fan of that series. And, you know, no more Rock in it, but Jason Momoa is in it, though.
I mean, there are just so many.
Vin Diesel, he's got to hit the gym. What's with this guy? He's a main character. I just want more muscle tone from him there, Praz. I had to say it. I had to say it. I had to say it. I'm sorry, Vin Diesel.
Get at me on Twitter. Diesel shade. Please. I just wonder, these guys going to be 80 and still driving.
Of course he is. Look at this guy. Well, he's not going to be 80 and doing this if he doesn't hit the gym, Praz.
Woo, okay.
I'm going tonight to the gym for sure.
Let's switch gears for a moment, because there was an ad buy in some markets that had to do with Tesla. It wasn't by Tesla. It was actually an anti-Tesla group that showed a Model 3 swerve into traffic and cruise through do not enter signs. So basically trying to spotlight some of the self-driving safety concerns about the brand.
Yeah, Julian, a more serious end, you know, the Dawn Project, which is backed by billionaire Dan O'Dowd, who's a Tesla critic. They ran this ad in select markets like Washington, D.C. and a couple of other state capitals with the Tesla Model 3 supposedly in full self-driving mode, running over child mannequins, hitting strollers, ignoring do not enter signs, and even driving past school buses. So, you know, some Tesla fans are alleging fraud. You know, we'll see, but it's getting people talking for sure. And, you know, Tesla is in the midst of a big FSD investigation with NHTSA and the DOJ. And so it's just not really a good look right now for them on such a high profile stage.
Yeah, those ads are jarring, Praz. I know you're also talking and watching Ram.
Yeah, you know, I think Ram had one of the funnier ads of the night, the premature electrification ad here. Good writing here. You know, are you as an American suffering from premature electrification? Meaning, are you kind of concerned about EV range and anxiety, things like that? Jason Jones, our comedian, doing a good job there. You know, of note, Saz, we actually did see the production or close to production version of the Ram Rev EV pickup. So we saw that they're very different looking than the actual concept that they showed earlier last year. And finally, you know, they're talking about stuff like range extender capabilities, which I don't think most Americans understand. But I think the big issue is that the truck won't arrive till 2024. That's a long ways away when you consider the fact that possibly the Cybertruck will be here by then.
Yeah, well, I'll believe that when I see it, Praz. Come on. All right, thanks a lot. Appreciate it. Coming up, 3 things you need to know this week. We're going to break down what's ahead next. Well, we told you about the 3 things you need to know today. Let's talk about the 3 things ahead on Yahoo Finance, a preview of what we're watching for the week. We start with Coca-Cola. The company is set to report tomorrow morning before the open. Investors are expecting another bubbly quarter, so to speak.
I was going caffeinated quarter from Coca-Cola,
well,
Julie.
bubbly works. Fizzy?
Yeah, I'm looking for margins. Coca-Cola was very out in front of, I think, just last year, cutting expenses, getting its portfolio under wraps. Very interested to see how margins are holding up, given the pullback we've seen in inflation. Now, PepsiCo, when they reported last week, you really got a little bit of everything from them. Solid top and bottom line, some good guidance. I wouldn't be surprised if you hear some more of those upbeat comments from the likes of Coca-Cola, just given the work it has done cutting back on expenses and new product innovation. Then, you will probably also get a little bit better results internationally, even though currency effects might depress sales a little bit.
Yeah, it looks like we are looking for about 45 cents a share in earnings that analysts are anticipating. This is not a stock, by the way, that tends to move a lot after earnings, right? It tends, it looks like options are pricing in about a 3% move in either direction tomorrow. So don't expect like huge swings necessarily. That's typically not what we see. Now I've jinxed it, but typically that's not what we see for something like a Coke.
All right, we're also watching Marriott. They're set to announce earnings tomorrow before the opening bell. Hotels, of course, benefiting from the post-pandemic boom, just like we heard just moments ago from Expedia CEO Peter Kern, noting that January was off to a good start, and his tone around that, I think, suggested February's been off to a pretty solid start, too, in terms of bookings. But again, Marriott in focus, you want to pay attention to their average daily rate, occupancy trends. When Hilton reported last week, we talked to their CFO, Kevin Jacobs, noting a strong forward bookings trend, and also Hilton noting occupancy levels improved in every division of its business. I would expect you would hear the same thing from Marriott.
Yeah, and we'll also get some commentary on how the fourth quarter looks versus January and beyond, just like we talked about with Peter Kern of Expedia. This stock does tend to move a little bit more on earnings. 4% is its implied move that's being priced into the options market, so that's something to watch as well. And then the third thing that we're looking out ahead to is not later this week. It's in 6 minutes. Our 11 a.m. special that's coming in just a few minutes. We're going to take a look at the year ahead in crypto. You see some of the folks that we're going to be hearing from here. Obviously, regulation. That is going to be one of the big topics, especially after we got the news this morning that the SEC is now filing a complaint against Paxos, which is a stable coin that is operated in partnership with Binance. So just a lot of concerns about what is going to continue to happen here in the wake of FTX. And as regulators continue to take a look at crypto.
Yeah, it seems like crypto is, the move in Bitcoin. It broke through 20,000, has lost a little bit of steam. So I can't wait for that chat. Some good work there by our colleagues. Looking forward to seeing Brad Smith.
Yes, indeed. And then speaking of a different Brad Smith, looking at some other stocks that we're watching. Microsoft
is that a reference to President and Microsoft Brad Smith? Wow.
Yes, it is. Yes,
that is impressive, Julie.
That was a segue
That's
of
awesome.
the story.
Good for you.
Microsoft, one of the best performers today. We're seeing those shares up by 3%, or I should say on a relative basis in big tech. There are some new analyst notes out on Microsoft from the likes of Stifel and Morgan Stanley and BMO, and that they're pretty optimistic about how the company is going to do longer term growth here. Positioned for more consistent results as Azure growth likely stabilizes, according to the folks over at Stifel. And they're saying the company should see healthy free cash flow gains over the next year. So maybe that's one of the things that's helping push Microsoft up. In addition, I got to think that the ChatGPT stuff is still helping the company.
All things AI. Microsoft shares outperform on a relative basis, just hammered Google last week as those two companies went toe-to-toe, dropping new product announcements. And Wall Street is just gaga. They are now, if they weren't already obsessed with Microsoft as a stock, they are really obsessed now. Not only is this company outgrowing revenue and earnings faster than its competitors, now they have new technology to hype at every single investor day.
And one more thing to mention, by the way, as we look ahead, we're going to be here early tomorrow.
Are we?
We are. CPI's tomorrow.
Oh, yeah.
We're going to break CPI tomorrow morning. We've been talking about how CPI is the big number of the week. Yeah. And we are going to bring that to you right when it comes out and see if it does indeed come out. Remember, the core number is supposed to rise 0.4% month over month, which is not necessarily what you want to see, even as the longer term trend is that inflation increases are slowing down a little bit.
Yeah, really excited to see what happened with egg prices. Yeah.
Egg
You
prices.
know me, I
That's
love
the
me some
thing
egg
that
prices.
I know you do. I actually paid about $3.50 for a dozen eggs.
I scooped up $3.29 over at Aldi.
Ooh, wow.
Aldi's
Well,
my new
Aldi,
stuff.
yeah,
Aldi's
that makes
like,
sense.
I think they're eggs. I can confirm they were eggs from Aldi, but as for the rest of the stuff.
All right, we got stocks that are on the rise here. Coming up, stay tuned for our 3 to 5 show as well with Dave Briggs and Sean Smith. They'll get a pulse check on consumer spending with MasterCard's Michelle Meyer, one of our faves. You don't want to miss that. Keep it right here.
This is a Yahoo Finance special, Crypto in 2023. Prices of cryptocurrencies are surging this year. Bitcoin is up around 40% with other popular digital assets like Solana up even more than that. That's a big turnaround after last year's crypto crash when the speculative bubble burst as the Fed spiked interest rates. Now, investors are hopeful for a hot crypto summer in 2023. But there's a lot still weighing on the sector. The Fed's aggressive rate hikes, a slew of bankruptcies, the aftermath of the collapse of FTX, and the criminal case against dethroned crypto king Sam Bankman-Fried. Over the next hour, we'll examine the future of crypto, including the best trading, investing, and tax strategies. And the big question, what will take us to the next crypto bull market?
Hello and welcome to this Yahoo Finance special, Crypto in 2023, brought to you by Intuit TurboTax. I'm Rochelle Akufo alongside Brad Smith. So, of course, after a tumultuous 2022, three key themes are unfolding in the early part of this year as investors continue to pick up the pieces of a tarnished sector. Now, firstly, the regulatory crackdown is gathering pace. Crypto firm Paxos ordered by a New York state regulator to stop creating new coins for Binance's stablecoin. Now, this as it reportedly faces a lawsuit from the SEC for offering the coin in the first place.
The prevalence of stablecoins continues to be a theme that we're watching, whether it's fiat-backed stablecoins or the algorithmic versions. The fiat-backed type are expected to continue to dominate developed markets as ever big issues as either there is a lack of any clear, coherent regulation here, Rochelle.
And we know that's putting a lot of people off doing what they do with exchanges. So finally, storage, of course, then becoming another key area. Security, obviously top of mind, but the type of facility you use will be based on your individual needs. Now, hot storage is an app connected to the internet, while cold storage is done offline.
Now, crypto didn't have much in the way of winners in 2022 as exchanges and currencies folded following exchange collapses and an investor pullback. So let's look at the survivors and losers last year and look ahead to this year as well. We've got Yahoo Finance's Jared Blickery here with us in studio. Jared, take it away.
All right, well, let's think about the last few years. We've had some incredible gyrations in the risk markets, and crypto has been really leading the way. So I compared the 2022 returns to the 2021, 2022, and what we have so far this year. Now, 2020 was the beginning of the pandemic. We had that huge bear market in stocks, and you take a look at what happened here. We had a pretty big dip in Bitcoin prices, but then towards the end of the year, we had all the stimulus unleashed by the Federal Reserve and also the fiscal agents of the U.S. and around the world, and we saw this huge rise. Well, that continued in 2021 in this little cyan line here. And in fact, a lot of prices peaked not only in the early year, but in later in the year as well. And so crypto didn't have quite the year, at least most of the tokens didn't have quite the year as 2021, but 2020, but 2021 ended up being a pretty good year. Now, 2022 is when the rubber hit the road. And of course, that was when we got that huge bear market in the U.S. in stocks, and we also had central banks around the world suddenly get hawkish. And here we can see in this orange line, boom, we hit some really low lows. And of course, we know what happened with the FTX bankruptcy. Before that, we had the Celsius fallout. Suffice to say, retail traders really were the big losers last year, in addition to all the people and entities we see in bankruptcy court. Now, take it to 2023. Guess what? This little red line here, let me clear all this noise here. We do have Bitcoin up about 30% for the year and Ethereum up about 20%. So let's take a look at our heat map here and track some of the winners and losers. There you see Ethereum up 23%. Now, if I change this to a one-year view and sort by performance, we're going to see a lot more red than green. And some of these have lost almost all of their value, and some of these we've also taken off the board. But you can see FTT token down 96.5%. What I find remarkable here is we were just talking about the Binance token. We've seen this retain and be very close to its stablecoin value of 1%. We haven't seen that many fluctuations over the last year. So the news apparently not affecting this tape. But some of the winners and losers here, you take a look at Ethereum down 48%, so is Bitcoin over the last year. People might be surprised to learn that Dogecoin is only down 45%. So Dogecoin, the relative outperformer despite its joke inheritance there. And then just taking a look and thinking about who might survive this year, who are the winners going to be? I think it's been shown that Bitcoin and Ethereum are here to stay. We've got some other tokens, Ripple, for instance. I don't know what's going to happen with the SBF favorites like Solana and some of the others. Solana down 78%, but those are going to have a lot more work to do. So it looks like things are improving right now. We do have liquidity flows into the market. We've seen stocks rise this year, but really Bitcoin has been leading the way for stocks. They've been wagging the tail. So whenever we get one of those big announcements, and I'm going to be watching CPI this week, guess what? I'm going to be watching Bitcoin over stocks, guys.
Certainly, we have seen that correlation get a lot tighter between Bitcoin and inflation data. Jared, great stuff there. Well, with the market still looking for a thaw in the crypto winter, let's look at what investors are watching for 2023. Joining us now, two Wall Street and crypto veterans, Caitlin Long, founder and CEO of Custodia Bank, and Jan van Eck, CEO, and of course, Yahoo Finance's very own David Hollerith. A big welcome to all of you. So first, I want to start with you, Caitlin, because a lot of people, they're seeing, especially this rise that we've seen in Bitcoin. But what does the landscape actually look like right now when we go sort of beyond a lot of the noise of the headlines?
Well, there's certainly a lot of optimism in emerging markets where adoption is propagating both of Bitcoin itself and the Lightning Network, which is a layer 2 solution for small value payments that is propagating at a rate that is greater than the rate of stablecoin growth. And what's interesting about the Lightning Network is any currency in the world can be transacted on that one just simply by locking up the amount of Bitcoin to collateralize it. And so this is essentially a means by which the emerging markets are getting access to US dollars without touching the US banking system. There's a lot of reason for optimism there. However, in the US markets, as you have correctly pointed out, there is a regulatory crackdown underway.
Jan, yeah, and that's a good point. VanEck is a large investor in emerging markets. It also has a Bitcoin price target for $250,000 as of 2028. So with that, I also wanted to point out your outlook for 2023 is that the markets are going to be a bit sideways, mostly for equities has been generally what it sounds like you're saying. So I was curious, thinking about that in retrospect, do you expect Bitcoin's trajectory to follow that of equities as we've seen in the past, or what's your expectations for it this year?
Actually, no, is the short answer. And I would say, yes, that's a long-term price target for Bitcoin. And I derived that really by saying that Bitcoin could achieve half the total market cap of gold. Both gold and Bitcoin really trade against the Fed. So when the Fed is super tight, like it was last year, those are difficult times for both assets. But the reason I'm cautiously optimistic this year for Bitcoin is because at some point the Fed will stop tightening. And we also have the halvening, which is expected in May of 2024. So I think at least in the second half of this year, it will look really rosier for Bitcoin. Now, if I may really quickly, we've had this spurt in the Bitcoin and risk-on assets earlier this year. And our basic thesis is that's come from a surprise increase in global money supply that's happened mainly out of Asia in the last couple of months. And I'm happy to talk about that.
We will come back to that in a moment. Caitlin, I did want to get back to you for a moment, especially considering your platform. You are regulatory compliant. You have transactions across digital assets and traditional financial systems. However, a lot of people who may be looking to get into crypto, they are looking for that insurance that they can kind of count on. And so when you think about the runway or the timeline towards having crypto assets federally insured, what is that kind of base case build in that you and the team think about?
Oh boy, federally insured is not on the table. In fact, it's actually the opposite. And to be clear, Custodia Bank is not yet taking customer deposits. We are building. And with the regulatory environment in the US so fluid, a crackdown started with the White House, the Federal Reserve Board of Governors, and the Kansas City Fed, all on Friday, January 27th, where there was a movement against Custodia Bank to deny our membership application to become a Fed member bank. Subsequent to that, the OCC has taken action. Now, last week, the IRS and the SEC, there's more SEC action coming up this week. So the notion that these assets will ever be federally insured is in fact quite the opposite. There is a crackdown trying to go after stable coins, trying to debank the industry, and trying to clarify the magnitude of unregistered securities in the industry. We're finally getting clarity, the regulatory clarity that this industry has begged for really since I've been involved, which is more than 10 years now. We're finally getting some clarity from the US regulators. And boy, have there been a lot of activities that have been, shall we say, of questionable legal authority and jurisdiction by the agencies in Washington, D.C.
Yeah, and Caitlin, just to add to that, there's obviously a range of enforcements that have been happening. But if we just focus on Custodia, why do you think the Federal Reserve decided not to allow Custodia to join as a member bank?
Well, it talked publicly about the novel and unprecedented activities, and Custodia has proposed to cut those out of its business plan. Again, everyone's trying to figure out where's the line here. And is the goal of the Biden administration, again, this is White House led, is the goal of the Biden administration to choke off all crypto across the board, period? Or is this really just about stablecoins and unregistered securities? And Custodia Bank, I think, was, well, we were the first to be targeted in this wave. It's now clear that the wave is quite broad and quite deep. But the interesting question is, if you look at the wave that's taken place, it's debanking the industry, it's cutting off stablecoins, fiat-backed stablecoins, and it's also clarifying unregistered securities. Custodia fit into those first two buckets, a bank serving the industry, it proposed in our business plan, as well as issuing a US dollar stablecoin-like instrument called AVIT. We have cut that out of our business plan. And so potentially they shot the stallion to scatter the herd, so to speak, as we would say in Wyoming, in part because we actually fit into two of those buckets. The real question at this point for the industry becomes, how far is this debanking wave? Is the goal of the Biden administration to completely debank the industry, in which case the entire thing moves offshore? But because, of course, this is internet native money, it won't go away, and people will still continue to use it. Or is the goal really just to go after stablecoins and unregistered securities? If it's the latter, then as this shakeout takes place, there will be, I think, phoenixes emerging from the ashes, so to speak.
And so then, Jan, for retail investors who really saw some heavy losses here, we're also, though, still seeing institutional investors perhaps still taking a different route as we're seeing retail investors pull back. What is the end game here, do you think, for some of these institutional investors when they look at the road ahead right now?
I think institutional investors, frankly, are still licking their wounds after last year, and might be opening their eyes to crypto, but not doing anything meaningfully this year. And I don't even think retail investors have gotten that involved either so far. I think why are we here? We're here. Crypto has the opportunity of cutting the costs of the financial system by maybe 90% to the consumer. And as Caitlin was talking about, overseas, it gives a lot of people who need access to a stable unit of value like the US dollar, access to that if you have a cell phone. And so there's a lot of good end that can bring to users around the world through crypto. But boy, the regulators are really shooting a lot of horses, to use Caitlin's analogy, recently here in the United States. What does that mean? I would add one other observation, which is not only does it move activity offshore, which is the reason FTX was in the Bahamas in the first place, but it is also pushing a movement towards decentralization, away from the types of entities like centralized exchanges that right now have been getting a lot of market share. So that's really moving more towards a decentralized basis, more peer-to-peer, more wallets that the government can control even less.
Thank you so much, both of you, for joining us this morning. Caitlin Long, founder and CEO of Custodia Bank, and Jan Van Eck, CEO. Thanks so much. We appreciate the conversation and the time. Coming up next, the race to regulate crypto. After years of sitting on the sidelines, lawmakers in Washington, the Capitol, they are now demanding a new playbook for crypto. We'll run down what Congress and the feds are working on and how it's going to affect you. We'll be right back. For years, regulators gave crypto a relatively light touch. It's one of the reasons that the crypto market grew so big so quickly, but not anymore. After a series of spectacular flameouts in the past year and many burned investors, it seems everyone in Washington, from the White House to Congress to the SEC as well, is now proposing a raft of new rules. Yahoo Finance's Jen Schonberger has the details.
The failure of FTX and arrest of Sam Bankman-Fried has heightened lawmakers' resolve to regulate crypto, with members of Congress criticizing the risks.
My fear is that we'll view Sam Bankman-Fried as just one big snake in a crypto Garden of Eden. The fact is, crypto is a garden of snakes.
The Senate Banking Committee kicks things off Tuesday, holding the first hearing on the crypto crash and why safeguards are needed for digital assets. In the wake of FTX's failure, Senator Cynthia Lummis, who co-sponsored the most comprehensive bill to date to regulate crypto, hopes to tackle renewed concerns and tighten the strings on the crypto industry. Senator Elizabeth Warren's next move on crypto is to reintroduce a bill with Republican Senator Roger Marshall to crack down on crypto money laundering.
Crypto has become the preferred tool for terrorists, for ransomware gangs, for drug dealers, and for rogue states that want to launder money.
In the House, Representative French Hill, chair for the subcommittee on digital assets, wants to continue bipartisan progress towards legislation to regulate stablecoins. Also on the docket, what defines a security in crypto land and how crypto firms can be held accountable for violating securities laws. SEC Chair Gary Gensler has warned that if crypto exchanges and lending platforms do not come into compliance, the SEC will take more enforcement action this year.
They can do that appropriately, working with the SEC, or we can continue on the course with more enforcement actions, and I would have to say that the runway is getting shorter.
The SEC has already brought 2 enforcement actions against crypto firms this year, including a lawsuit against Genesis Global Capital and Gemini Trust Company. Outside of Washington, Europe is set to adopt sweeping crypto regulations this spring, while the UK is considering a central bank digital currency, or Bitcoin.
Still ahead, we'll take a closer look at the proposals to regulate crypto and how the new rules promise to protect investors, but still allow the crypto market to innovate and flourish. We'll be right back.
Welcome back to a Yahoo Finance special, Crypto in 2023, brought to you by Intuit TurboTax. Joining us now is former SEC Senior Trial Counsel Howard Fisher, as well as Sultan Megji, who is the first ever Chief Innovation Officer at the FDIC. Also joining us for this conversation, we've got Yahoo Finance's Jen Schonberger. Let's begin the conversation here in studio. Sultan, thanks so much for taking the time here. First and foremost, when you think about innovation within the FDIC, what does that even entail, especially as it relates to crypto, and what steps still need to be taken at this point?
Absolutely. Well, when I was inside, what we did was really try to think about innovation in three ways. One was modernizing the agency. You know, that's an agency where it's a lot of paper and files, and, you know, they didn't even, couldn't use their iPhones correctly back in the day, right? The second is making sure that the FDIC, as the primary bank regulator, was being efficient and using technology to do a better job, especially finding bad behavior in the banking system. Everything from, diversity and equity issues all the way through to terrorist financing. And then the third was trying to foster thoughtful innovation inside of the regulatory context so that we could continue to be the most powerful and most useful banking platform globally. And that included crypto.
Yeah.
Howard, Jennifer Schonberger here, if I could come to you. Curious for your reaction on the SEC reportedly suing Paxos on issuing Binance's stablecoin, apparently a violation of securities law as an unregistered security. What implications do you think this has for the regulation of stablecoins and stablecoin issuers?
Yeah, I think you're seeing a very interesting last 6 months in the crypto world as it relates to the SEC. The SEC has essentially claimed to be the regulator of digital assets, and it's done that not by issuing regulations, but by bringing enforcement actions against Gemini and Genesis, against FTX, against alleged insider traders of Coinbase coins, against Kraken. And now it's threatening to bring a case regarding stable coins. It looks like what the SEC is doing is essentially saying that none of these programs, none of these assets, none of these structures are legal, and they're just going to shut them down. And the way they're going to do that is by arguing that they are securities. And as securities, they need to be registered and regulated. And if they're not, they'll be halted.
So, Sultan, a lot of people wondering about the rules here because some institutions like Coinbase saying that it doesn't apply to them, that they don't offer a yield like Kraken does. So then if we're using, say, the Howey test for what is a security, then do some of these exchanges fall outside of that? And should that still be the test that we use to determine what is and isn't a security?
It's a great question, and frankly, you're exactly right. There are a number of situations where crypto is creating products and services that don't sit inside of the legacy regulatory environment. And let's remember, most of the definitions for these things are 30, 40, 50 years old, before digital technology existed. And so, this is a situation where instead of having kind of an open, transparent dialogue that leads to new legislation being created that really defines guardrails, you have a number of agencies. SEC is one of them. The prudential banking regulators, Fed, OCC, and FDIC are others, where they're taking their existing rules and just trying to morph them around this environment in kind of an opaque way. I mean, we've seen it with the SEC over the last few days, and Howard did a great job summarizing that, but also we've seen it with the Federal Reserve and OCC, in essence pushing against people like Custodia Bank, and I saw you had Caitlin on a few minutes ago. Basically they were doing the right thing. They were filling out an application, they were going through the process, and now they're saying, no, you look like X even if you're not X, and we're going to treat you that way. And so it's really, kind of wonder if it's a square peg round hole kind of thing. And right now, since there's no legislation, there's nothing to stop these agencies from using their existing authorities like this.
Howard, building on what Sultan just kind of alluded to there, if we look at the failure of FTX, many of the breakdowns were not all that different from what we saw in the traditional financial sector over the past decades, right? The most egregious of that being using customer accounts to trade for the house, which is what we saw at FTX, something that is barred under traditional broker-dealer rules. So my question is, why isn't it that the SEC is taking enforcement action to require exchanges to register rather than doing one-off securities here and there? I mean, I put that question to Chair Gensler, who puts it back to the exchanges, and the exchanges are pointing back to the SEC. So we have a lot of finger pointing here. Having been a trial lawyer for the SEC, why is this happening? Why aren't we seeing greater enforcement action from the SEC to get these exchanges to register?
I think the metaphor might more appropriately be not finger pointing, but hot potato passing. And with many things, like with many things in our society, it would be really nice if Congress got together and passed a law or a set of laws or structures that governed how the crypto world was going to be dealt with. Unfortunately, they haven't done that, and I'm not sure that there is the political will to do that. And so as a result, the SEC has stepped into the breach, and it's done so by regulating through enforcement, which is perhaps not the most optimal way to do this, but it might be the only available way to do it. And I think, one of the things that we need to think about when we talk about regulation is what's the purpose of the regulation? Do we want to regulate crypto to protect investors? Do we want to regulate crypto in order to promote the creation of a stable industry? Or do we want to regulate crypto in order to protect the traditional financial services and banking sectors from any potential contagion? I don't think that there is a political agreement as to what the purpose of regulation is and what the purpose of crypto regulation should be. And I think until we get that agreement, we are not likely to see legislative efforts to remedy this. And as long as we have that gap, SEC and other regulators are going to step into the breach by doing enforcement and regulating in that way.
Okay, so Sultan, here's the thing though. We're discussing regulation, but at a lens of U.S.-specific authorities, does there need to be a consortium of international regulators that actually come together and recognize the fact that we're dealing with or trying to put some guardrails, at least, around what is a very global type of transactions spectrum that's taking place?
Well, the challenge is there's so many different international bodies all working on this in parallel, and similar to Howard's comment, like what you see in the U.S. is a microcosm of what you're seeing globally, whether it's the European Central Bank or the governments in the Middle East or Bretton Woods or Basel. Everybody's kind of playing in their own little pocket, and no one actually has agreement. Like, just getting people to agree on what a stable coin is by definition is something that they can't do. And so until I think we see some leading nations, and I think a lot of people are looking for the United States to build some clarity around it. We are the most powerful financial services nation in the world. We have 57% of global reserve currency last time I checked. We are the people that everybody's going to follow. And the fact that we can't follow right now is causing a lot of issue. And so you see crypto going into these little dark corners, whether it's bad guy behavior in the Caribbean or whatever. You see it in Malta and places like that. You see the Russians and Iranians creating a gold-backed stablecoin to trade oil in violation of sanctions. This is what's happening to this market because we're pushing it out of the U.S. infrastructure.
Understood. Gentlemen, thank you so much for taking the time here with us today. Former SEC Senior Trial Counsel Howard Fisher, as well as Sultan Megji, who is the former Federal Deposit Insurance Corporation Chief Innovation Officer, as well as Yahoo's own Jennifer Schonberger. Thanks so much. And up next, everyone, your complete guide to crypto and taxes. Yeah, that. From coins to NFTs, we're going to dig into the new IRS rules and how everyone's tax forms are going to look different this year. Stay with us. We'll be right back.
Welcome back to this Yahoo Finance special Crypto in 2023, brought to you by Intuit TurboTax. Well, tax season is upon us and returns are due at the IRS by April 18th. And there are lots of new things to watch for this year, especially for crypto investors. Joining us now is Swan Bitcoin Managing Director Terrence Young. Thank you for being here. So Terrence, obviously over the past year, we've seen a lot of losses. We've seen some exchanges collapse as well. What do people need to be aware of considering the rule changes as they file for 2023?
Sure. So basically, before the 2023 tax deadline, right, your goal should be to pay the correct amount of taxes to avoid penalties, take advantage of tax benefits, and reduce your audit risk, given that crypto does have a target on its back, as you said, Rochelle, with the regulatory action. So I would do a couple things. I would make sure you collect documentation on sales and in crypto investments that went to zero, as many of them did last year when the bubble burst. And I would also download the tax CSV file that you have from places where you purchased your Bitcoin or crypto, and use tax software. Could be TurboTax, could be Bitcoin and crypto tax software such as Zenledger. And then lastly, I would hire an accountant, give them plenty of time to do your taxes, give them good documentation so they do a better job, and think of tax deductions and credits you may qualify for.
Is the IRS's understanding of crypto a moving target here, Terrence, given the fact that there's so many changes year over year, and even the type of ownership that people decide to have in their relationship with crypto?
It certainly looks like it, but us Bitcoiners, of which I am one, we've been warning people for years about how crypto outside of Bitcoin are mostly securities, if not all securities. So for the IRS and other regulators to go after crypto and consider them securities is not a surprise. We hate to say we told you so, but this is something that anybody who has a legal background like I do, or talked to their friends who are securities lawyers, or just went to law school and took a securities law class, this was pretty obvious.
So Terrence, in terms of the mistakes that you tend to see people make when it comes to filing their taxes in regards to crypto, what tends to be the ones that stand out to you?
Sure. So a big one is not taking advantage of tax loss harvesting, where you can make lemonade out of lemons. So 2022, a lot of us saw mark-to-market unrealized losses in our Bitcoin and crypto exposure because many of us bought during the bull market, during the hype in 2021. So what you want to do, ideally, is sell and rebuy your Bitcoin. And in the past, I would have said crypto, but given that the SEC and the IRS are taking a new look, a more aggressive look at crypto and considering them securities, you actually can't rebuy crypto immediately because you would violate the SEC 30-day wash sale rule. Bitcoin is still property under the IRS rules and should continue to be that way. But regardless, if you have losses in Bitcoin, you could sell immediately, rebuy, and lock in that tax benefit by crystallizing and realizing your capital loss.
Terrence, what about for small businesses that may be holding some Bitcoin on the balance sheet? I mean, we talk about publicly traded companies who have some form of crypto. They're holding that as an asset or as an investment. But what about for some of the smaller businesses that might also be hodling, if you will?
I mean, this is not advice, but if I were them, I would continue to hodl or hold their Bitcoin, because long term, if you can afford as a small business to keep your Bitcoin there and not sell it for 5 years or longer, it should do quite well. The longer you can hold it, the more likely it is that this bearer asset that has a credible finite supply will be very valuable in the future. Short term, who knows? As Warren Buffett would say, in the short term, the markets are a voting machine. In the long run, it's a weighing machine. And the weight of Bitcoin's fundamentals are very strong. Crypto, I'm not so sure. I would not hold crypto at all. I would get rid of that.
All right, Swan Bitcoin Managing Director Terrence Young, thank you so much for joining us this morning. We appreciate it.
Welcome.
Absolutely. Coming
Thanks
up,
for having me.
Yes, certainly. Coming up, everyone, we speak with the CEO of Grayscale Investments about the current landscape of the crypto industry. You don't want to miss that. Stick around. Welcome back. You're watching a Yahoo Finance special, Crypto in 2023, brought to you by Intuit TurboTax. Joining us now for a deeper dive into the world of cryptocurrency, we've got Grayscale CEO Michael Sonnenschein. Michael, great to have you here with us, as well as Yahoo Finance's Jen Schonberger. Michael, just to start things off, broad strokes here, Crypto 2023, people are wondering, coming off of 2022 and the crypto winter that we've entered into, what 2023 holds. What do you believe is on the horizon?
Well, first of all, it's great to be here. Thanks for having me, guys. I would say that investors are not deterred. What we've seen in crypto over the last couple of months is a tremendous amount of leverage that's come out of the crypto ecosystem. And as we move into the better part of 2023, I think investors are focused on some upcoming catalysts around the crypto ecosystem. There's a major upgrade coming to Ethereum. We're about a little more than a year away from the next Bitcoin halving. And certainly today, I'm joining you from Washington. There's a lot of conversation going on around crypto in Washington with recent events, certainly not deterring policymakers, but instead, perhaps we see 2023 as a year where regulation becomes front and center for crypto.
We will get to that regulation for certain, as our own Jen Schonberger covers Washington very closely here. But Michael, I got to wonder, for Grayscale specifically, how do you look at these next 6 to 12 months and how critical they could be?
There's no question that the entire resources of the firm are focused on our lawsuit right now. So for those of you who are just tuning in, Grayscale sponsors the world's largest Bitcoin fund, Grayscale Bitcoin Trust, ticker GBTC. And we have been working proactively to convert GBTC into a spot-based Bitcoin ETF here in the US. And the SEC denied GBTC's conversion in June of 2022. And since that time, we've been in active litigation with the SEC. And so the case is proceeding swiftly, and the oral arguments will be heard at the beginning of March. And we could have a decision on the case as soon as the fall of 2023. So squarely focused on our litigation there, and really, again, protecting our investors and doing what's right by them.
Hey, Michael, Jennifer Schonberger here. It's great to see you. On those oral arguments that are set for March 7th here in Washington, what can we expect? What do you plan to argue? What's your case?
Well, the SEC really has taken a stance that is what we think arbitrary and capricious. They allowed Bitcoin futures-based ETFs into the market and have continued to deny spot-based Bitcoin ETFs from coming to the market. Ultimately, we have straightforward, common sense legal arguments that we believe the court will be persuaded by, and feel that, when we think about recent events in crypto, we have to think about protecting investors, continuing to give them full and fair disclosure. And there's certainly no question that moving to a spot-based ETF would certainly give investors greater protection, greater regulatory oversight, and again, very confident in our arguments as we head towards oral arguments in early March.
Michael, if you don't get the outcome that you hope for with this lawsuit, I know you've proposed a possible plan B where you could tender 20% of the shares outstanding. That would require a conversation with the Securities and Exchange Commission for a more customized plan to adhere to legal requirements. Have you spoken with the SEC to try to lay the groundwork for that if you don't get the outcome that you want on this lawsuit?
That's exactly right. So earlier in this year, we did announce the possibility of a tender offer if we do exhaust all of our legal options in contesting the SEC's decision around GBTC converting to an ETF. In order to facilitate a tender offer, we would certainly need shareholder approval, but would also have to work proactively with the SEC to obtain relief from the tender offer rules. Unfortunately, I have to say that reaching a tender offer would be a less optimal outcome. The most optimal product structure here is a spot-based ETF. It would allow the product to track the Bitcoin that it owns day to day, the way that all ETFs have that embedded arbitrage mechanism. And again, would really give investors greater oversight and protection sitting on a national securities exchange. So if we did end up in a scenario where we were pursuing a tender offer, it would really mean, solidify that the SEC and the regulatory community here in the US was continuing to shut the door on bringing Bitcoin, even closer into the regulatory perimeter.
Michael, how have the SEC proceedings impacted fund flows right now?
I'd say that investors are generally in it for the long haul. Grayscale investors really are folks that have long-term conviction in crypto, and we fortunately have investors across all 50 states. This includes retail investors, this includes institutional investors, and typically what we see is when we're in these range-bound times, investors typically are slow to allocate, and as soon as they see crypto beginning to break out, they begin to dollar cost average back into those positions.
Michael, you're a subsidiary of the Digital Currency Group, which is also the parent company for Genesis Global Capital, which recently filed for bankruptcy in the wake of FTX's failure. DCG is reportedly selling large positions in several crypto trusts that are operated by Grayscale at a deep discount to try to raise money to pay back creditors. What can you tell us about this, and what sorts of further ripples could we see as a result of this bankruptcy pop-up?
It'd be really difficult to comment on the specifics of what's happening with Digital Currency Group, since it's not the business that I'm responsible for day to day. What I can share is what's out there in the public around DCG, which is that as a company that invests in private companies, that holds tokens, that invests in Grayscale products, that incubates businesses, DCG is reportedly selling some positions in some of the Grayscale products that it owns, really as part of its regular portfolio rebalancing. But beyond that, I'm not how much more to make of DCG's recent sales.
Michael, I don't mean to be grim here, but for a lot of the companies in the crypto landscape, the management teams have had to try and figure out, how do we get to the other side of this crypto winter? How do you approach that at Grayscale?
It's a great question, Brad. We've been really principled and really deliberate in building the Grayscale business. I have a phenomenal leadership team. I have a phenomenal organization that has continued to focus on all the tasks in front of us as a team and never getting distracted by headlines. We have been a lean and mean organization that's really been focusing on building the foundational infrastructure of the business. So our own broker-dealer, our own registered investment advisor, and really continuing to operationalize Grayscale that will allow it to scale for its future growth. We're an organization that did not get out over its skis. We didn't take on leverage. We didn't get too large as a company. And we've been through 2 crypto winters before, and we're weathering this crypto winter as well.
And Mike, 1 second. Have you had to also reduce headcount, restructure costs anywhere?
We're always being cost conscious. So when we think about our service providers and any of the other organizations that we're aligned with, we're always doing things in a way that gives us optionality so that we're never overcommitted as an organization. And I think having that agility has been really, really key to Grayscale's long-term success.
Michael, we always appreciate getting some time with you, always appreciate the time, the perspective, and the analysis, as well as what the future holds for crypto. Michael Sonnenschein, Grayscale CEO, thanks for the time today, as well as Yahoo Finance's Jen Schonberger.
Thank you, guys.
And you can check out the full interview with Grayscale CEO Michael Sonnenschein over at the Yahoo Finance homepage. Coming up next, Beyond Bitcoin here. The big change is coming to our lives as we move towards blockchain technology.
Cryptocurrencies and blockchain technology are setting the stage for a new era in personal finance, digital payments, and all sorts of financial transactions. But it's also going way beyond that. Joining us now to explore the promise of blockchain and how it will change our lives is Algorand Foundation CEO Stacey Warden. Thank you for joining us this morning. So for a lot of people who are wondering, I know you have a pure proof of stake approach with Algorand here. What does that mean, though, for the average person who's trying to understand how blockchain could be working in their lives and in their businesses?
Yeah, we're a layer one blockchain, which means we provide the underlying layer for all kinds of people to build on top of us. So we don't build specific applications. We enable applications to be built on top of us. And we have a very efficient blockchain with a very low carbon footprint. We were founded by Silvio Macaulay, who is maybe the world's most famous cryptographer, living cryptographer. He's a Turing Award winner, tenure professor at MIT, the whole bit. And our blockchain uses a pure proof of stake consensus mechanism, which enables it to be very decentralized and also very fast. So we do about 6,000 transactions per second, moving to 10,000 transactions per second this year at a very low cost. So it's a sub-penny transaction fee and a very light carbon footprint. So we use and again, it's our consensus mechanism that enables us to do this, but we use the energy of about a small neighborhood, and we buy carbon offsets to make sure that we're always carbon negative.
How will people, Stacey, realize the difference, the delta in their day-to-day experience when blockchain truly is part of that experience? And what will the benefit be?
Yeah, I mean, I think of the big five, and the number one is always going to be payments and smart payments. And, right now, if somebody in Brazil wants to send somebody in France a movie, they can do that in 1 minute over WhatsApp, a movie. But if somebody in Brazil wants to send somebody in France $10, it has to travel through the correspondent banking system of the US, clear at the Fed. Somebody takes between 6 and 8% off the top, and it might get there, 4 days later. And the fundamental value proposition of a blockchain is actually that currency doesn't move at all. It's that it's one ledger. The history of financial transactions has been really for the last 10 years that each bank has a balance sheet, and the messaging between those balance sheets has gotten better and more efficient and cheaper. But a blockchain is a completely different animal. It's one ledger. So that transaction between, say, Brazil and France will happen immediately. It'll happen in 3.9 seconds on Algorand. No forking, final settlement, not reversed. And that is just a huge fundamental thing to understand about blockchain. And then in addition, there's things that you can do on blockchain, like marshal identity. You can do tracing of goods. So for supply chain, you can have a more democratic governance system, and you can do tokenization of real world assets. So there's, I call those the big five, and I can talk about each one of them. But I think the important thing to understand is that it's one ledger that everybody writes to. And of course, if it's one ledger, you can't have one entity control that ledger. It has to be decentralized, because if one computer gets attacked, it has to be able to live in a healthy manner on all of the other computers.
And I want to ask you, because obviously we've seen generative AI front and center. How do you see that playing into perhaps the speed and reducing costs of things on blockchain?
Well, I don't know that AI has a lot to do directly with blockchain, but for the apps that sit on top of blockchain, for sure, you can imagine AI kind of optimization of protocols, for example, and of course the messaging and the communication between AI type bots and the user interface, I think could have a much better user experience. But the idea of a blockchain is that transactions are entered, and then they are immutable. So a blockchain is not about truth so much, but it is about integrity. And so that you know when something is entered, nobody else can mess around with it. And that turns out to have very important implications for all kinds of things.
Indeed. Well, we do appreciate you joining us this morning. Algorand Foundation CEO Stacey Warden, thank you for joining us this morning.
Okay, thanks for having me.
Well, of course. Well, that wraps it up for our crypto special today. I mean, we've covered everything from regulation to tax loopholes, stablecoins, and of course, where the blockchain ecosystem takes us next. I'm Rochelle Cooper along with Brad Smith. Brad, any final words here in terms of what you found the most interesting today?
You know, I just continue to take a look at the price action on Bitcoin, quite frankly, and try to get a sense of where we go from here and the levels that we've got to break through. I know Bruno Mars wrote the song 24 Karat Magic, but that 24K is going to be an interesting marker, a breakthrough point, as we've seen some resistance there. We'll see if Bitcoin is able to break through that and have the hot crypto summer, or lead it, as we had teased earlier on in the hour.
I'll certainly be keeping an eye on that regulation by enforcement path that we seem to still see the SEC going on. Well, that'll do it for us. But of course, everyone, please stay tuned for live coverage between 3 and 5 p.m. Eastern Time, where we'll look ahead to a big retail sales report with MasterCard's Michelle Meyer. You don't want to miss it. Goodbye for now.